All right, we're beginning a long reading, multinational operations. It's long because the examples are pretty detailed and there's no way to get around it. There are no little short examples you can put on the screen and say, here we go, here, look at this is how it's done. The examples, when I get to one, I'll do a detailed one, span over 5, 6, 7 screens, only because there's so much that you have to do. But what I'm going to do when we get to the all of that long part of the examples is I'm going to point out to you what part of it you need to focus on, because while you have to understand the process, it would be unrealistic for you to have to replicate the process in the real world. For the most part, you'll be looking at the outcome of a currency translation process, and you'd have to understand the process to understand how that outcome came to be and what is the likely impact of any future outcomes given certain things. Without going into too much detail, I'll focus on that. But don't get mired down in the detail, in the accounting detail of it. What you want to do is you want to understand the process the accountants go through. But your main objective here is to focus on the impact it has on the financial statements. All right, so let's see if I can't get that for you. Anyways, let's begin. The learning objectives don't flow very well in order, so I'm going to do them out of order. I'm going to do A, B, and then I'm going to jump to D, because C and E are better handled after that. And even though the chapter deals with inflationary scenarios early, I'm going to do it much later. So if you're looking for this video to line up well with the chapter in order, not really. It flows a lot better the way I'm going to do it. So let's go. First of all, let's get some terminology out of the way, because this terminology will really trip you up. There are 3 words we need to know: presentation currency, local currency, and functional currency. So I'm going to build into that. Let's say we have 2 companies, A and B. A is a U.S. company that does its transactions in U.S. dollars. B is a Mexican company, does its transaction in Mexican dollars. And A exports some product to B, and B agrees to pay A in 60 days, but the bill is in Mexican pesos. So for company B, there's no issue. It deals with Mexican pesos. It has an accounts payable in Mexican peso. It has no foreign currency exposure. A, on the other hand, has an accounts receivable in Mexican, but it's a US-based company. So it needs to translate that Mexican amount, the peso amount, into dollar amount. So if we look at it in terms of a timeline, at one point in time we have an account receivable set up, and at some future point in time we have a payment. So because the exchange rate between the US and the Mexican currency, the US.MXN, fluctuates, the US dollar value of any accounts receivable, or if it happened to be a payable, any AP, will also fluctuate. This is called a foreign currency transaction. So let's look at the next big topic of this chapter. We're going to spend some more time on the foreign currency transaction after we introduce our terminology here. The next, the big topic, or the biggest topic in this reading, is the foreign currency subsidiary. So let's see what that looks like. Let's say that we have a parent company A, and its functional currency is the US dollar. Now, I just introduced a term, which I'll introduce again later on with more formality. But for now, think of it as this way. A functions in the US dollar. That means it buys and sells and primarily does all its transactions in the US dollar. We call that the functional currency. It has subsidiaries in different countries, in Canada, Mexico, in the Eurozone somewhere, and in Australia. So B, C, D, E. These are the functional currencies that these subsidiaries have. So B's functional currency would be the Canadian dollar. C's functional currency would be the peso, etc. Each of these subsidiaries within these specific countries have to keep records in the host country currency. That we call the local currency. So for instance, B is in Canada. It does most of its transactions in Canadian dollars, so we say that that's its functional currency. Within that country, it's still a taxable reporting entity within Canada. It still has to submit tax returns to Canada, which would mean that the Canadian dollar is its presentation currency or its reporting currency, and it is the local currency. Typically, all 3 will be the same. The local currency, the functional currency, and the reporting currency will be the same within the subsidiaries, typically. Not always, but typically. the parent has to consolidate. So we can see the issue right here. If the books, the balance sheet and the income statement for B, C, D, and E are in Canadian dollars, pesos, euros, and Australian dollars, well, how do we express that in US dollars? There has to be some exchange rate that's used. But the question becomes, well, which exchange rate do you use? Because the income statement is for a period of time. Do you use the exchange rate right at the end of the period, or the exchange rate at the beginning of the period? The balance sheet represents balances that were purchased at differing times. Well, which exchange rate would you use? So you have to translate these currencies to US dollars, and that's the big effort we're going to spend time on, is how do you translate these balances that are in euros or Australian dollars into US dollars? And here for company A, its functional currency is the US dollar. It's based in the US, so that's also its local currency. And since A is consolidating all of these, the presentation currency is in US dollars. It has to translate all of these into US dollars. So let's get formal with the three definitions that we have to use, because I'm going to use these quite a lot. I'm going to use the term presentation currency a lot, and I'm going to use the term functional currency a lot. And you really, when I use these terms, you can't slow down and think, well, hang on a second, what is this now? You really must understand it. The presentation currency is the currency in which financial statement amounts are presented, plain and simple. Typically the currency of the country where the company is located. Now, let's say that I'm a Canadian company and I have a subsidiary in the U.S. And the U.S. subsidiary does all its business in U.S. dollars, but I'm a Canadian company. I still must report my income to the Canadian tax authorities, and the U.S. subsidiary must still report its income to the U.S. Tax authorities. So my U.S. subsidiary's functional currency would be the U.S. dollar, which happens to be the local currency, but it is my subsidiary's reporting currency. But my reporting currency is the Canadian dollar. So I have to translate that currency into my currency. In other words, the subsidiary's functional currency is not the same as the parent's presentation currency. Okay, so there's the presentation currency. So functional currency is the currency of the primary economic environment in which an entity operates. The currency in which the entity primarily generates and expends cash. That's oftentimes very easy to figure out. If a subsidiary is in Canada, chances are they have a Canadian location, which has Canadian lease costs. They have Canadian employees, which cost Canadian dollars. They're doing business in the country of Canada, which brings in Canadian dollars. And maybe they're exporting, which brings in a foreign currency. So they might be exporting to the U.S., which happens to be, maybe that's my home currency for my Canadian subsidiary, but for the Canadian subsidiary, it's still a foreign currency. So because of all of this going on, you have to just think about each unit independently and say, okay, well, let me get this straight. The subsidiary's functional currency is what, and its presentation currency is what? The easiest way to do this is this. Whatever country the company happens to be in, that's the company's presentation currency will be the local currency. So let's say I'm in the U.S., I have a subsidiary in Canada. Right away, I know the Canadian subsidiary's reporting currency is the local currency, which is the Canadian dollar. So I never have to ask questions about, well, what is my Canadian subsidiary reporting in? It must report in Canadian dollars. It's the local currency. The U.S. parent must report in U.S. dollars. It's the local currency. The functional currency is where you have to think about it. Which one is the functional currency? And you may think it's fairly straightforward, but in many cases, there could be a judgment call. Let me give you a situation where there could be a judgment call. Let's take a Canadian hockey team from the NHL. In case you didn't know, all NHL hockey teams pay salaries in US dollars. So we'll take the Toronto Maple Leafs, TMP. It pays its salaries in US dollars, but its gate is in Canadian dollars. The gate, meaning the ticket gate, is in Canadian dollars. If the company is profitable, it will bring in more Canadian dollars than it spends in US dollars. You can make the argument that the functional currency is the Canadian dollars because there's more of them. But what if it shows a loss? That means it's bringing in fewer Canadian dollars than it's spending US dollars. You would say, well, because most of the transactions occur in US, the US must be the functional currency. Which one would you choose? You have to choose one. Let's take another company that hires in Canada and it operates on a purely break-even basis, but exports 100% of its product to the U.S. and charges U.S. dollars, but pays all of its expenses in Canadian dollars. What's the functional currency? Remember now, it operates on a break-even. Well, that's hard to tell, right? So later we'll look at a list of criteria that we can go down to determine which one is the functional currency. So again, it's the currency in which the entity primarily generates and expends cash. And I've given you two situations where, well, for Toronto Maple Leafs, depending if it's profit or loss, it could fluctuate back and forth. For the break-even company, you could flip a coin, right? So we'll look deeper into that. Typically, the presentation currency is the functional currency. So we would say, well, the Toronto Maple Leafs are based in Canada. They must report to CRA, the Canadian Revenue Agency, in Canadian dollars. So it seems to make sense to call that the functional currency. Same with this Canadian company that's exporting everything to the U.S. We may call that the functional currency, but it has the word typically in front of it. And typically it is. In most cases you come to, the presentation currency of the subsidiary will be its functional currency. Typically, but not always, and it's that extra thing that we got to pay attention to. The local currency, that's easy. It's the currency where the company operates. So for the Toronto Maple Leafs, the local currency is Canadian. Its presentation is Canadian. We just haven't figured out what the functional is. For the exporter, the local currency is Canadian. The presentation currency to CRA is Canadian. We just haven't figured out the functional. So you see, the local and the presentation will be easy to figure out for every company and every subsidiary we have, because it's what country are they in. The functional currency is where we have to use some thought. And typically, all three are the same currency. Typically. Again, there's that word typically, right? Typically, you won't have to make this decision. It'll be pretty straightforward, but there are some instances where all of a sudden it's not as straightforward. All right, LOSB is going to deal with nothing but currency transactions. So we're not going to worry about parent-subsidiary relationships right now. We're just going to worry about transactions. And we've already got the definitions down, the presentation currency, the functional currency, and the local. And we've learned that we need to pay attention to the functional currency. The presentation and local will be pretty benign. It's the functional currency that matters. So by definition then, a foreign currency is any currency other than a company's functional currency. Period. That's nice and simple. As soon as we decide on what the company's functional currency is, any other balance that it has, whether it be on its balance sheet or whether it showed up on the income statement, is a foreign currency transaction. Foreign currency transactions are those denominated in a currency other than the functional currency. So let's take two companies, A, whose functional currency is the US dollar, which happens to be the local currency. A is in the US, it has the US dollar. B is a Canadian company, its functional currency is the Canadian dollar, it's the local currency. So for A and B, their functional, their local, and their presentation currencies are all aligned with the country they're in. For A, the Canadian dollar happens to be a foreign currency. For B, the US dollar happens to be a foreign currency. So wherever they're located, since this is the functional currency, any other currency, I just picked one, it could be any other currency other than CAD, is a foreign currency. There are two types of transactions which can lead to a foreign currency transaction. Import or export in a foreign currency. So the Canadian company can export something and bill it in US dollars. That's a foreign currency transaction. However, if the Canadian company exported something and billed it in Canadian dollars, even though it's an export, it is not a foreign currency transaction. It may still be a foreign transaction, but it's not a foreign currency transaction. It's still billed in Canadian dollars. The other side of the transaction, the importer, who now has to pay Canadian dollars, if it's exported, clearly it left the country, it's in a different currency, in a different country with a different currency. The importer now has the foreign currency transaction. So if A and B were importing and exporting with each other, whenever there was a transaction, an import or an export, one of them is going to have foreign currency transaction, but not both. If the US exports to the Canadian company, the currency will either be US dollars or Canadian dollars. It would make little sense for a US company to export to Canada and bill it in yen or euros. It's going to be in one of them. So if the U.S. company bills the Canadian company in Canadian dollars, the Canadian company is clean. There's no foreign currency transaction. It belongs with the U.S. company. If, on the other hand, it bills it in U.S. dollars, the U.S. company is clean. The Canadian company has foreign currency transaction. So an import-export relationship may bring up a foreign currency transaction. It will on one of the sides, but maybe not the company we're looking at. Or we can borrow or lend in a foreign currency. So perhaps A is going to borrow in Canadian dollars for some reason. Well, it may have all sorts of reasons why it would want to do that. It might borrow in Canadian dollars. Perhaps it's buying a subsidiary in Canada and wants to pay Canadian dollars, is going to hold the debt at the parent level. Then that would be also considered a foreign currency transaction. Any of these two leads to an asset or liability in a foreign currency. Now, I need to make a point here. If A sells to B in Canadian dollars, A has a foreign currency transaction. That transaction may not lead to an asset or liability if A sells to B with no terms. In other words, I'll sell it to you, but you got to pay me now. Well, when they pay, B will pay at a rate that's whatever is the current spot rate that day, and it'll be exchanged, and that's it. There will be no accounts payable, no accounts receivable, no balance on the balance sheet. So if a foreign currency transaction does not lead to an asset or a liability in a foreign currency on the balance sheet, then there's no issue. There'll be no issue at all. There might be, A sold to B, let's say for $10,000 Canadian, and by the time B paid and they went to the bank to deposit it, the exchange rate shifted a bit and they only got 9,995. Maybe there's a $5 difference. There might be a gain or loss on the transaction itself, but there would be no foreign currency exposure any longer. That would be it. It would be over. That would be a realized gain. When you have an account, an asset or a liability in a foreign currency at a reporting date, you're going to have some unrealized loss or gain. That's the issue. That's what we're focusing on. That becomes complicated to deal with. Okay, so let's set up a situation between two companies. Here's company A, its functional currency is the euro. Here's company B, its functional currency is the peso, the Mexican peso. And let's say that B exports to A, and A will pay in 45 days. But A will pay will pay pesos, a fixed amount of pesos. So it owes in Mexican pesos, but it will use, in 45 days, it will use euros to buy pesos, so that becomes a variable amount. Because there might be an exchange rate today that may not exist in 45 days. It may require more euros to extinguish that debt, or it may require fewer euros to distinguish that debt. But the value of the import from A's perspective, because it's B's export, the value of the import is recorded on the day that it's received, on the day that ownership, title to ownership transfers to A, at whatever the exchange rate is that day. But when it goes to pay, it might be a completely different exchange rate. You cannot change the value of what was purchased because of that. It becomes a gain or a loss. So, to set up on a timeline, you have the record date, the date at which the transaction was recorded, and you have the payment date at some point in the future. During that period of time, you have something called transaction exposure to Forex risk or foreign exchange risk. So, over that period of time, you may register a gain or a loss. How do we treat that? IFRS and GAAP says the change in the value of the foreign currency asset or liability. And if we're taking 45 days to pay, company A has what in this case? Has an accounts payable. So that is a foreign currency liability. B does not have a foreign currency asset, on the other hand, because it's going to be paid in pesos. Its functional currency is in pesos. It has nothing. It has no transaction exposure in this particular case. The European company does. The change in the value of the foreign currency asset or liability resulting from a foreign currency transaction must be a gain or loss on the income statement. Look at all the language we have in here, right? Foreign currency asset or liability resulting from a foreign currency transaction. You have to be clear now, we're talking about a foreign currency transaction only. The gain or loss goes onto the income statement. We're not talking about any parent-subsidiary relationship. We're just talking about a foreign currency transaction. That's it. The gain or loss on the income statement for IFRS and GAAP. When we get to foreign currency subsidiaries, we're going to see that that is not the case between IFRS and GAAP. But for just a transaction, well, it goes right on the balance sheet. Right on the income statement. So let's do an example. Let's throw some numbers behind this just to give it some concreteness. So B exports to A something worth $100,000 and bills it in pesos, 100,000 Mexican pesos. And then A, in 45 days, which will be December 15th, will pay the Mexican company. So November 1st is the record date. December 15th is the payment date. In between here, we have transaction exposure. Let's say that the exchange rate, the MXN.EUR, was 0.0684. And remember how we read these currencies. The first currency is your base currency. We always associate 1. Whenever you read a currency that's written like this, which is the typical way that a spot rate is written, is MXN.EUR. That's called a currency pair. 1 applies to the first one. So 1 Mexican peso buys 0.0684 euros. 1 buys that. So 100,000 must buy 68.40. If 1 buys that, we just simply multiply by 100,000 to get what 100,000 buys. So 100,000 pesos is 6,840 euros. So if our European company paid for it on November 1st, the day it received it, it would pay 6,840 euros. On December 15th, the exchange rate, 1 Mexican peso bought 0.0703 euros. So did the Mexican peso strengthen or weaken? Well, here, 1 only bought 0.06. Now it buys 0.07. 1 Mexican peso buys more. So it strengthened. Well, it turns out now that the European company must now spend 7,030 euros to pay off 100,000 Mexican pesos. If they would have paid for it on day 1, it would have cost 68.40. So the payment costs 190 euros more, which means we have a loss of 190 euros. We could have paid 68.40, but because the exchange rate worked against us, we now must pay 7,030 to pay off a debt that's only 68.40. So we lost 190 on the deal. To look at it in transaction form, on November 15th, the European company would record inventory of 68.40 and an accounts payable of 68.40. Notice that its accounts payable is in euros, 68.40 in euros. They don't list it on their books in pesos. Remember now, they must keep their books in the local currency, in their presentation currency. So they record it as 68.40. But when they go to pay, the cash that's leaving is 70.30. So here's how we transact for it. Well, 70.30, we know that 68.40 went to extinguish the accounts payable. We can't say that more went to extinguish the accounts payable because, well, that's not what was in the account. We can only bring it to 0. We need to put this 190 somewhere. That's a loss. And since it's realized now, it's going to go straight to the income statement. And that's what it does. It goes straight to the income statement. What happens to our balance sheet and our income statement in this effect? Our cash is going to drop by 7,030 euros, but increase by 190 times the tax rate. Now, if you're looking in your textbook in the curriculum, it doesn't make this distinction. It doesn't make the distinction at all. It basically just says when it gets to retained earnings, that retained earnings drops by 190. But let's be clear, that's a very simplified example assuming no tax. We want to be as real world as we can. We're going to spend 70.30. Our cash is going to drop by 70.30, but we have a loss on the income statement of 190, which will reduce our taxes. So the taxes that we pay will be 190 times the tax rate less. So it will increase our cash balance by 190 plus the tax rate. Our inventory goes up 68.40. Our retained earnings go down by 190, 1 minus the tax rate. And our income statement, we have a Forex loss of 190, which is realized. So in that last example, it was a rather straightforward example. What sets it apart from the example we're about to do is that last example, we initiated and extinguished a foreign currency transaction in the same reporting period, within the same quarter. There was no reporting in between the initiation and the extinguishment of that liability or that asset, depending on which side of the transaction you're sitting on. But what happens if we initiate a foreign currency transaction on a particular date and we extinguish it at a date later than our reporting date? which means on the reporting date, we're going to have either an accounts receivable or an accounts payable that has foreign currency exposure, which means we now have balance sheet exposure at that point in time. How do we deal with that gain or loss? Because it is unrealized at that point in time. It's not realized. When it's realized, it's pretty straightforward. It goes right to the income statement. You've realized a gain or a loss. Let's do it. But if it's unrealized, do we still do it? Let's find out. Here's a scenario. November 15th, a European company has an accounts receivable of £10,000. December 31st, it must report, but it doesn't get paid till January 15th, which is the payment date. On the date that it sets up that account receivable, the exchange rate between the pound and the euro was 1.46. And remember how we read it. Our base currency is here. 1 British pound would buy 1.46 euros. So if we receive £10,000, if we actually got it on the 15th, we could cash in those £10,000 and get 14,600 euros. We'd have that much more cash. December 31st, the exchange rate is at 1.48. So 1 British pound now bought $1.48 1.48 euros. So 10,000 of them would now get 14,800 euros. So we could have gotten 14,600 euros on November 15th. As of the reporting date, if we got paid that day, we would have 14,800 euros. So we have an unrealized gain in our account receivable of 200 euros. Then from the reporting date to the payment date, the exchange rate dropped to 1.475. So between 14,800 and 14,750, we show a loss of 50 euros. Overall, we have a gain of 150 euros. Do you see that? From this period of time all the way to the payment date, £10,000 would have bought us 14,600. Now it buys us 14,750. But we have this reporting thing in the middle where we have an unrealized gain, but then we have an actual realized loss, which gives us a realized gain of 150 over that period of time. But we have the idea of unrealized versus realized. Now, typically, unrealized gains or losses do not go to the income statement. They'd go to other comprehensive income and then get transferred to the income statement once they become realized. Is that the same thing here? No, it's not, which makes it rather complicated, because once you get into thinking that, hey, my realized gains will go to the income statement, my unrealized gains really can't show up there, I got to put them somewhere else, and that's what the OCI is for. But IFRS and GAAP go to the income statement, period, whether they're realized or unrealized. That's just a rule they have. Any currency translation. And this right here, while we engaged in a foreign currency transaction, as of December 31st, when we recognize this unrealized gain, that is not a foreign currency transaction. That is a foreign currency translation of a previous transaction. So we need to be careful about the words transaction and translation here. The currency translation gain or loss, and that's what we have here, that's a translation gain or loss, goes to the income statement. So let's be clear. If we have a foreign currency transaction that initiates and extinguishes within a reporting period, we have a realized gain or loss. It goes to the income statement. Nothing about that conflicts with anything that we've learned anywhere else. Nothing does. However, if we have a foreign currency transaction that initiates and extinguishes between reporting periods, at some point we have a foreign currency translation. That translation gain or loss is unrealized. What we've learned about unrealized losses says don't touch the income statement. But in this case, for a foreign currency translation of a foreign currency transaction, it hits the income statement. Difficult, right? Now, you may think, okay, I'll just remember that anything that's foreign currency goes right to the income statement. Once we get to foreign currency subsidiaries, that is not the case always. And that's what makes this a little bit complicated, is because here we break the rules. It's been a firm rule so far, unrealized gains and losses don't hit the income statement. But if it's a result of just a foreign currency transaction, just a transaction, then it does. So that's just one of those things where you say, okay, well, there's no intuition there. I just got to memorize that. Yes. Now, to make it a little bit more complicated, because if it were easy, we wouldn't need accountants and a whole profession would be out of business. So it has to be complicated to justify their existence. Here's another complication. This gain or loss can either be a component of other operating income or expense or a component of non-operating income or expense. So it can either show up in operating income or it can show up in just income before tax, after operating income. So where does it go? The choice will affect the operating profit margin, and IFRS and GAAP says put it wherever you want. They have no rule of where to put it. So they're going to break the rule. The unrealized gain is going to go to the income statement, but they're not going to be clear about which side you could put it on, either operating or non-operating. So as the analyst, you're saying, oh, come on, man. All right, well, let me get my hands dirty. So this, by the way, what I'm about to show you down here, this is probably the most important relationship that you have to try to internalize as fast as you can. You must be able to see these relationships very quickly. So if we have asset exposure, this is our exposure, by the way, asset exposure. If we have an account receivable, it means we have a balance sheet asset exposure. If we have an accounts payable, it means we have a balance sheet liability exposure. This is our foreign currency. So if we have asset exposure, which means we should be receiving money, we will receive a foreign currency. If it strengthens, we'll have a gain. That's a positive impact. If it weakens, we'll have a loss. If we have a liability and the foreign currency strengthens, we'll have a loss because we got to pay more of our own currency to get it. And if it weakens, we'll have a gain. You should be able to see these relationships very, very clear. And I think about it this way because I'm in Canada. I think if I got $100 in my pocket, that means I have an asset, a foreign currency asset. I won't call it a receivable. I'm just going to call it an asset. I got $100 in my pocket. What benefits me? Well, if the US dollar strengthens, if the foreign currency strengthens, it benefits me. That's all I have to know. Here's why. Because if it benefits me, if it strengthens, it must hurt me if it weakens. And if it benefits me when it strengthens as an asset, it must hurt me if it strengthens as a liability. So to keep this relationship straight, that's all you have to know. Because look, the opposite, both ways, changes. The sign just changes. So all I have to know is, hey, look, if I got $100 in my pocket, what benefits me? If it strengthens, great. Because from there, all I have to do is put negative, negative, plus. I can figure out the rest of the chart nice and easy for that. That's a nice, easy way to keep it straight. Okay, let's just get clear in our head where on the income statement these gains and losses, both realized and unrealized, could show up, just to see the effect it would have. Because that's what we want to, that's really our focus here, is what effect does it have on the statements, because that's what we're analyzing, right? We're not accounting for the transaction, we just want to know the effect. So let's set up our scenario, 2000x1, 2000x2. Let's make the same thing in each year: revenues, cost of goods sold, other operating expense, and non-operating expense. So we have the same scenario, except in 20x1 we have the gain of 200 that we saw on the last screen, the unrealized gain, and in 20x2 we have the realized loss of 50. So let's deal with 20x1 here, and then we'll move on and deal with 20x2. And we'll do it under two scenarios. We'll put the gain under operating expense, and then we'll put the gain under non-operating expense and see what happens. Revenues are the same, and cost of goods will be the same in both, so gross profit is the same in both. Notice that it doesn't affect the gross profit margin. Wherever the company puts it, it won't affect the gross profit margin. We're good there. If you go all the way down to net income, notice it won't affect net income, because you're going to put it somewhere before we get to net income. So your gross profit margin and your net income margin, you're okay. It's in your operating profit margin where you get messed up. Because if you put it in operating expense, if we had 5,000 in operating expenses and we have a gain of 2, we now only have 4.8 in operating expense. We have an operating profit of 3.2, which is a 16% margin versus 15%. And if you put it down here, our non-operating expenses go from 1.2 to 1. We can see that it's the operating profit that gets a little messed up. Let's go over to 2000x2, and we can see the same thing. Notice that the gross margin and the net income margin stay exactly the same, but it's where we put the loss. If we put the loss in operating expenses, our operating margin will be lower. If we don't put it there, our operating margin will be 15% versus 14.75. So, because there's choice in where it goes, what you're going to have to do when you look at a company is say, well, let's find out if it had any foreign currency transaction, and if it did have any foreign currency transactions, where did it put any of the gains or losses, realized and unrealized? They all go there. Where did it put it? And if it put it in the non-operating section, you'll find this information in the notes. There's disclosures about this. If it put it in the non-operating section, you might want to bump it back up to the operating section, especially if you're comparing operating profit margins across different companies that may not have had that as well, or that may be mixed. If you're comparing a bunch of companies that treat it the same way and put it as a non-operating expense, you don't necessarily have to bring it back up because every company will be comparable on its margins already. All right, so just to repeat, since the standards specify no placement on the income statement, companies can choose. The unrealized gains or losses are included in net income on the balance sheet date. So we get that. They're in net income. Now, the unrealized gains or losses may not actually be realized. Some of these, if we noticed in the previous example that we did, as of December 31st, we had an unrealized gain of $200. That was never realized. What was realized was a $150 gain spanning the time of initiation to expiration, but it was never actually realized. The realized gain that we did report in the end was $50 because we had the unrealized gain of $200. So just because we have an unrealized gain or loss of a particular number, that particular number may not actually be the amount that's finally realized. Think of a scenario like this. Let's say that we have our initiation date, our expiration date, there's our reporting date. And let's say that we have a gain on a currency of $500, and by the time it goes to pay, we have a loss. Because this is the reporting date, we'll show an unrealized gain of $500, but we'll show a realized loss of $500. So you can't think of it in terms of that the unrealized losses will eventually be realized. We don't know, they may just disappear, but they will offset so that the net will be the same. Disclosures, IFRS requires disclosure of, quote, the amount of exchange differences recognized in P&L. So you'll get the number. IFRS requires that a company discloses that amount. GAAP requires the disclosure of, quote, the aggregate transaction gain or loss included in determining net income for the period. Different language, same result. They're going to give you the number. Neither requires disclosure of the line item in which the gains or losses are located. That makes it kind of messed up. The disclosures can be found in either the MD&A or probably more likely somewhere in the notes. Now, on the previous screen, I said that neither required disclosure of the line item where it's located, but typically, not only will they disclose the amount, but they'll say exactly what part of the balance, the income statement they put it in, included as part of operating income or expenses or as part of non-operating. Typically, they'll tell you that because if they don't, they just get asked by analysts over and over and over and over again and have to keep answering the same question. So when we look at the disclosures in the annual report and all of the footnotes, a lot of those footnotes have evolved from previous analyst questions that kept recurring and recurring. So it becomes an evolving document that when we read that, we say these are all questions that have been asked before. If they're putting out more information than the requirement, it's because they just don't want to keep answering those same questions over and over and over again. They'll stick it in there. So it's going to be in there. If the amounts are immaterial, they're typically not disclosed. So even though the amount would still be in there, if it's immaterial, it won't be disclosed. When is it immaterial? Limited transactions. So a company may do $1 million a year in sales and import something from the US that might cost them $5,000 and there was a $72 currency loss on it. That would be immaterial. It probably wouldn't even be reported. Other situations are where you have a foreign exchange that's pegged, fixed, or stable. So one country will peg its exchange rate, let's say, to the US dollar, and most of its foreign currency transactions are with the US dollar, in which case there's no foreign currency exposure because you have either a pegged or a fixed exchange rate. That typically was the case before Bretton Woods. Bretton Woods allowed for freely floating exchange rates. Previous to that, many of them were pegged, which means you didn't really have that issue. But with freely floating exchange rates, yeah, you got that issue. You may have offsetting transactions, and this is what this looks like. Let's say that A is a U.S.-based company and imports from Canadian in Canadian dollars, but it sells to Canada in Canadian dollars. So at any given time, it's got accounts payable in Canadian dollars, it's got accounts receivable in Canadian dollars. This company would most likely maintain a Canadian currency bank account in which it would receive its Canadian receipts and from there issue its Canadian payments. So that because it has incoming Canadian and outgoing Canadian, when they net out, the net foreign currency exposure may actually be nil. Even though they may be large numbers on their own, the amount coming in and the amount going out result in almost nothing to declare. Which means, well, not they'd still declare, but there'd be no reason to disclose it because it's just too immaterial. Or hedging practices, using forwards or options, you may be able to hedge out almost all of your foreign currency exposure, and if you can do that, you really have no foreign currency exposure. The amount that would be there, resulting primarily just from basis risk, would be immaterial. You pretty much wouldn't disclose that either. All right, at this point we're going to skip over LOSC. We'll revisit it. It's just that it doesn't flow very well jumping from C back to D and then to E again. So we'll do D, and then we'll revisit C and E together because they really lend themselves to a more of an extended example. So now let's move on to foreign currency subsidiaries, and let's see what that looks like. Let's take A here as our parent company. Its functional currency is the US dollar. It has two subsidiaries, B and C. B's functional currency is the Canadian, and C's functional currency is the Mexican peso. B and C, their records and their financial statements must be in the local currency because B still is a Canadian company that must report to CRA, the Canadian Revenue Agency, and C is still a Mexican taxable reporting company that must report to the Mexican tax authorities. So their records and their financial statements are in local currencies, but the parent must consolidate the assets, liabilities, revenues, and expenses. So they must translate whatever balances are on the statements as of the date. They must translate for the subsidiaries' financial statements into the presentation currency. And of course, the presentation currency of the parent is the US dollar. That's the scenario. Here are the questions that we hope to solve. Number one, what is the appropriate exchange rate with respect to each financial statement account? Do we use the same exchange rate for all balance sheet and all income statement accounts, or are there different exchange rates that we would use? And two, how should the translation adjustment be reflected in the consolidated financial statements? Now keep in mind, all we're doing is let's take Canada here, the Canadian subsidiary. At the time it hands over its financial statements to the parent, the balance sheet is in balance and the income statement's net income is reflected in this company's retained earnings. By the time they translate everything, if you're using different rates for different accounts, it will then be out of balance. Unless you translate every single account on the balance sheet with the same exchange rate, it'll end up out of balance. That's called a translation adjustment. What do you do with that thing? Is it a gain or loss on the income statement, like we saw with foreign currency transactions? Or is it an equity adjustment on the balance sheet, like we would treat it as if it were other comprehensive income? We're going to see that the two answers are correct depending on how we translate it, and we have two broad ways of translating those balance sheets. So let's set up an example scenario so that we can follow it through with some numbers. It always looks better that way. And I'll take the one right out of the reading, Spanco, which is a European-based company. I imagine that must be for Spain. and Americo, which is a U.S. Subsidiary, and its functional currency is the U.S. dollar. So we have different functional currencies. And let's say that Spanco set up Americo on December 31st to 2000 X1 with 10,000 euros of capitalization at a time when the U.S. Euro exchange rate was 1. We read this as 1 U.S. dollar buys 1 euro. That's par, which means that 10,000 euros bought $10,000 of capital in Americo. And Americo then goes out and borrows $5,000. Notice it's a dollar, not a euro, and buys $12,000 of inventory. So on December 31st, Americo's balance sheet looks like this: cash of $3,000, inventory of $12,000 for total assets of $15,000, loans of $5,000, and common stock of $10,000 for $15,000 were in balance. If you translated that into euros on that very day, since it is par, you would get the same thing in euros, which means that when you take the assets minus the liabilities, you'd still have a $10,000 equity investment. It would be the same. Now, let's jump to March 31st, 2000 X2. 1 quarter has passed. No transactions. The company just sat there for 3 months, and it's just for exposition purposes, so let's just accept there were no transactions. The current spot is now 0.8. The historical spot was 1. The current spot is now 0.8. How do we read this? 1 US dollar buys 0.8 euros. Here, 1 US dollar bought 1 euro. So what happened to the euro? Did it strengthen or weaken over this period of time? Well, if $1 bought 1 euro historically on December 31st, and now 1 US dollar only buys 0.8 euros, the euro must have strengthened, or the other way of saying it is the US dollar must have weakened. Either way, we have a different exchange rate. Here's the thing, and what I'm going to do down here is I'm just going to prove to you something so that you can just take our word for it from here on in, or just take it at face value from here on in. The initial investment of 10,000 euros is a historical fact. That happened. There's no changing that. It happened at a time when the exchange rate was par. Therefore, we would use the historical rate. Now, this follows through in everything that we do. For every balance sheet we get to, we'll translate the assets and the liabilities, but not the equity. The equity will always be translated at the historical rate, period, except retained earnings. Except retained earnings. So I'm going to prove to you that that's the case. Let's say let's say that Spanco made an investment in Americo of 10,000 euros at par, and the company did nothing. It did nothing except park it in cash. So at par, you would have cash of 10,000 and common stock of $10,000. And if you translated it back, that would both be $10,000 in euro. 10,000 in cash, 10,000 in common stock. At 80 cents, if you translated both, you'd say, well, cash at 80 cents is now, if it's $10,000 US dollars, that only buys 8,000 euros now. Because the euro strengthened, it takes more American dollars to buy the same amount of euros. If you converted common stock, you get the same 8,000 to have it balanced, but you'd come to the conclusion that there has been no gain or loss. Does that make sense to you? If you translate both the cash balance and the common stock balance at the current rate, you'd come to the conclusion that there's no gain or loss. Clearly, that's wrong. So we can say that you cannot do it this way simply because we've arrived at a conclusion that's wrong. So if we translate the cash at the current rate but translate common stock at the historical rate, it sets up the scenario where we do have a loss. So we register that loss in common stock, negative 2,000, and that would then make it balance. So there you go. You must recognize that there's a loss. We still have to have a balanced balance sheet. But when you convert them both, you end up with the conclusion that, hey, there's been no gain or loss because it balances. That's clearly wrong. So hopefully that keeps it really sharp in your mind that the equity component of any balance sheet will always be translated at the historical rate at the time it was initiated, at the time it gave rise to the creation of the common stock. It'll be translated at that historical rate. I want to get that out of the way first, because really, when we translate balance sheets, we're looking at the assets, the liabilities, and only retained earnings. All right, so there are two approaches for the asset and liability accounts on the balance sheet. Number one, all assets and liabilities are translated at current rates, or what is called the spot rate. Whatever the rate is on the balance sheet date, that's what they're translated as. And number two, only monetary assets and liabilities are translated at the spot rate. Non-monetary assets and liabilities means we bought them at some point in time, should be translated at historical rates, the rates that existed at the time that they were purchased. So if we bought a building 6 months ago, what's that building worth? Well, when we translate it, now I shouldn't say what it's worth its fair value, but when we translate the currency amount should be translated at the historical rate that it was purchased at, not the current rate. So let's take our initial balance sheet, cash, inventory, loan, and common stock that we had, and let's translate it under scenario one, all translated at spot, and number two, monetary assets only at spot, the rest at historical rates. So if we're translating assets and liabilities at spot, notice it says all assets and liabilities. It doesn't say all accounts, just assets, liabilities. Why? Because common stock will stay translated at the historical rate. So we just multiply them all by whatever the current rate is, 0.8. So we'll have total assets of $12,000, but liabilities and equity are now $14,000. So to make it balance, we have to reduce the $14,000 by $2,000. We have something called a translation adjustment of $2,000. So we have the translation adjustment, now it balances, 12 and 12. If we translate just monetary assets at spot, well, cash is a monetary asset, it's $2,400. Inventory is not a monetary asset, it's a physical asset. So we translate at the historical rate. Remember, December 31st, we took out a loan and we bought $12,000 of inventory. So we translated at 1, we get $12,000, total assets of $14,400. The loan is a monetary asset, translated at the current rate, and equity is always, or common stock at least in the equity account, is translated at the historical rate for $10,000 for $4,000. We must add $400 to make it balance. That's our translation adjustment is $400 to get $14,400. So, look at these two scenarios. Under translating all of them, under method one, we have total assets of $12,000 versus $14,400. We have a translation adjustment of a loss of $2,000 versus a gain of $400. So we have a lower amount of equity here. We would have basically $8,000 of equity, because if you have $12,000 of assets and $4,000 of liability, there's only $8,000 of equity left. Whereas here we have $10,400 of equity left. So that's going to throw off our ratios depending on which translation adjustment that we're using. Or sorry, I shouldn't say which translation adjustment, but which translation method we're using. All at the current rate, or a mix of current and historical rates depending on the characteristic of the account, being monetary or non-monetary. Should we let companies choose? That would be a mess, wouldn't it? Well, it turns out there's a rule that must be followed. There's a rule that's followed that stipulates under this type of condition you would use method 1. Under the other type of condition you would use method 2. The problem becomes in comparing companies at the parent level with consolidated statements who have consolidated their subsidiaries under different methods. You can see right away that if two different companies consolidated this same subsidiary, one with one method, one with another, even though it's the same thing, even though they've translated the exact same economic unit, they would end up with different economic measurements, or maybe I'll say financial or accounting measurements of the same economic unit. Well, that you can imagine a company that has 50, 60 different subsidiaries in 50, 60 different currency areas. What a nightmare that would be to unwind all that stuff. It's a good thing there are rules. Okay, let's compare the two just for a minute, just to see what happened when we did the translation. When everything was translated at the current rate, the asset translation adjustment was negative $3,000. Our total assets dropped by $3,000. Our liability translation adjustment was in our favor by $1,000 because we owed $5,000. After the translation, it was only $4,000. So negative 3,000 on the assets, 1,000 on the liability. It's negative 2,000. That is called the net foreign currency translation gain or loss. Look at all the modifiers here in front of gain or loss. It's a currency translation gain or loss, but it's the net foreign currency translation gain or loss between assets and liabilities. And if you're using, if you're going to apply the current rate to all the assets and liabilities, typically a company's assets will always be more than its liabilities, since assets equal liabilities plus equity. If equity were zero, then of course the assets and liabilities equal each other. If equity were negative, then that wouldn't hold, but typically assets are greater than liabilities. So because of that, you're going to end up with a situation where if the currency strengthens, you'll have a net foreign currency gain. If it weakens, you'll have a net foreign currency loss, because you'll typically be asset heavy over liabilities. So if you look at it in terms of absolute value, the absolute value of the asset translation adjustment is greater than the absolute value of the liability translation adjustment. So because the translation adjustment for the asset is greater than the translation adjustment for the liability, the gain or loss depends on whether the currency weakened or strengthened, right? I'll talk more about that a little bit later. I just want to bring that up, that's an important relationship. Underlining this whole section is that theme, is to determine, does our subsidiary or does our method of translation result in a net asset balance sheet exposure or a net liability balance sheet exposure? So let's just pay attention to these little things we're doing here. If you're going to translate the monetary assets and liabilities only, the asset translation adjustment that we made was negative 600. Our assets went from 15,000 to 14,400, but our liability translation adjustment was 1,000 in our favor. We had a gain of 400. So here, using the current rate, we had a negative 2,000, so we had a loss. Here we have a $400 gain. They're both unrealized, by the way. These are both unrealized. So the question on both of them is, do they go to the income statement, or are they deferred in a separate component in equity on the balance sheet? The answer is yes. Yes, it goes to the income statement under a certain method, and yes, it gets deferred as a separate component in equity under certain conditions. So there are certain conditions under which these two would occur. We have to decide what conditions lead to the use of which method, and then once we have the method, we'll know how to treat the translation gain or loss. All right, so let's extend the idea of asset exposure and liability exposure to balance sheet exposure. The assets and liabilities that are translated at spot or at current rates are what are called exposed, or they are exposed to translation adjustments. Anything that's not translated at a current rate, if it's translated at a historical rate, from quarter to quarter to quarter, it'll be translated at that same historical rate. It will never fluctuate with the currency because now it's fixed. So it is not exposed to any translation adjustment. But any account that from quarter to quarter on the balance sheet and income statement that we translate at a current rate is what we call exposed to translation adjustment. So if you look at all of the assets and liabilities that are exposed, you may have a situation where the amount of the assets that are exposed are greater than the amount of liabilities that are exposed, or it could be the other way around. So rather than measuring the amount of asset exposure and the amount of liability exposure, we can net them out and measure something called balance sheet translation exposure. Is a balance sheet exposed positively or negatively to a changing currency? Well, that depends on whether it is asset exposed or liability exposed on a net basis. It's also called accounting exposure. So if we have net asset balance sheet exposure, that means of all the asset accounts that we're translating, the value of those accounts is greater than all of the liability accounts that we're translating. We'd have net asset balance sheet exposure. meaning our exposed asset value is greater than our exposed liability value. If we have net liability balance sheet exposure, we are saying that our exposed asset value is less than our exposed liability value. Now, why are we bringing this up? Why is this so important here? Well, if we're using the current rate method, in other words, we're going to use the current rate to translate all of our assets and liabilities, as we've said on the previous screen, it typically is the case that your assets will be greater than your liabilities simply because you'll have positive equity. Hence, you will have net balance sheet exposure. However, if you're translating only monetary assets, it is typically the case that almost all of your liabilities are monetary liabilities. None of them are physical liabilities. Oh, I got to return this car. They're typically all monetary liabilities, whereas not all of your assets are monetary. The majority of them, especially inventory and fixed assets, will tend to be physical or non-monetary assets, which means if you're using the second method to translate statements, your subsidiary will typically have net liability balance sheet exposure, where the exposed asset value is less than exposed liability. So, just as we did before, remember I said, if I have $100 American in my pocket here in Canada, what benefits me? It benefits me if that foreign currency in my pocket appreciates. We can look at the same thing for net asset exposure or net liability exposure in terms of the foreign currency. If we have net asset exposure to a subsidiary, I'm a parent, my subsidiary has net asset exposure. An increase in that foreign currency is a positive adjustment on my balance sheet. That's all I have to remember, because everything else is just an opposite of that. So if I can remember this right here, I'm good. It's the same thing. I have $100 in my pocket. What benefits me? If the $100 gets more valuable. I have a subsidiary in another company that has net asset balance sheet exposure. What benefits me? If the currency increases. What will hurt me on a consolidated basis is if the currency weakens, because now that'll be a negative adjustment to my equity. If I'm translating the balance sheet using the second method and I have net liability exposure, I would rather see the foreign currency weaken. So this is important to keep in mind, because it's probably, I think, to answer most of the questions. If you have this, if you see this in your head very quickly, when it comes to measuring the impact on the statements of a particular method, you'll see very quickly that if you have net asset exposure or net balance sheet exposure, net asset exposure with a foreign currency, you're hoping for that foreign currency, or what would help you is if the foreign currency increases. As an analyst, if you're looking at two companies that have the same performance and their subsidiaries are in different companies with the same performance, it just so happened that one of the parents now end up with a positive translation adjustment and another one with a negative translation adjustment, simply because the currencies of the two subsidiaries diverged. Well, you gotta understand that you need to make an adjustment for that. That's just a translation adjustment. It's not an economic reality of what went on in the subsidiaries in their own particular country. So it can get tricky. By the way, that extra component we add to the equity section called the translation adjustment, which is an account or a component on the balance sheet, it's a cumulative account. So from quarter to quarter to quarter, we just keep adding whatever the translation adjustment is. Some periods it might be positive, some periods it might be negative. Since it's unrecognized, and we're doing all of the assets and liabilities, which means the entire investment is exposed, the entire equity investment is exposed. Since it's unrealized, we would only realize it if we actually sold the subsidiary. Then whatever we realized would be the amount in that cumulative account. So the translation adjustment account is, if you take quarter one all the way through to how many quarters, each quarter it's just the sum of all the translation adjustments quarter after quarter after quarter. So it's a running balance of all the translation adjustments. Once the subsidiary is sold, whatever balance is in this account would then leave the equity section and finally then show up on the income statement as a gain or loss. That's consistent with everything else we know about unrecognized gains or losses other than the one we just saw earlier in Learning Objective A. So now that we have the broad strokes down, what we've just covered are just really the conceptual issues. I wanted to get in your mind the two methods to go. Let's actually put concrete names to them and look at the exact process, because the real process we go through is not as neat as what we just saw. That was just to show you the two different ways we can go. So let's look at the translation methods. The first one is called the current rate method, and that is all asset and liability accounts are translated at spot, in other words, the current rate at spot at the balance sheet date. All asset and liability accounts. Remember, we don't do equity here. That's called the current rate method. The second method is called the monetary or non-monetary method, where all monetary assets and liabilities are translated at spot on the balance sheet date, and all non-monetary assets and liabilities are at historical rates. So only the monetary asset and liability accounts are done at spot. The rest are done at historical rates. Now, while the current rate method is one that is used, the monetary non-monetary method is not quite there yet. That's just a broad method. The temporal method is used, which is a modification of the monetary non-monetary method, the temporal method, and it looks like this. Non-monetary assets and liabilities that are measured at current value are translated at current rates at the measurement date. So what this is saying is, let's take inventory. Inventory always is recognized at its current, at the most current price that it was purchased at. It's not listed at a historical price on day one. It never changes. It's measured at current value. So it'll be translated at the current rates, and these are the rates that existed at the measurement date. Once we get into an example, you'll see what we mean by that. Non-monetary assets and liabilities are measured at historical value, are translated at historical rates. So for the temporal method, the monetary assets and liabilities still get translated at spot at the balance sheet date. The non-monetary assets and liabilities now break up into two different types of assets and liabilities. Ones that are measured at current value and ones that are measured at historical value. Those measured at current value are translated at the current rates at the measurement date. Those measured at historical value are translated at the historical rates. So this, from an accounting perspective, this brings up a huge nightmare of having to track the exchange rate on dates of transactions. And yes, they have to. So as an analyst, are we expected to back out that kind of information out of one statement and put it in another? No, it would be next to impossible to do that kind of thing. So again, we're really focusing on what is the impact of all of this on statements and ratios so that we're aware of that impact, and are there corrections we can make for it without having to try to change all of the transactions between two companies to make them the same, because that's never going to happen. So now the reason this is done is the measurement basis in the foreign currency is preserved after translation to the presentation currency. Assets and liabilities at current value are translated at the current rates. Assets and liabilities at historical value are translated at historical rates. This is for IFRS and GAAP. So again, you have a current rate method and you have a temporal method. The temporal method is a modification of the monetary non-monetary method. So from here on in, you can ignore the monetary non-monetary method and just focus on a current rate method with one statement and a temporal method with 1, 2, 3 statements. So now let's get to the question of which method is appropriate. Can a company just choose on its own? Oh, I'll use the current rate. Oh, no, I'll use the temporal rate. Can it switch back and forth depending on which one gives it a gain? Well, no, there are rules this time, and that's nice. It depends on the foreign entity's functional currency. So let's say that I'm the parent and I have a subsidiary. The method that I choose would depend on my subsidiary's functional currency. If my subsidiary's functional currency is the same as mine, being that I'm the parent, I will use the temporal method. That's the one with 1, 2, 3 rules to it, right? 1, 2, 3 statements. I said, remember these 3 statements. If my subsidiary's functional currency is different from mine, which is most likely the case, then I will use the current rate method. So that sets it up nice and simple, right? If it's different, I'll use current rate. If it's the same, I'll use temporal. It's primarily going to be different. I will primarily be using current rate. That doesn't mean that the subsidiary's functional currency can't be the same as the parent. It would just be questionable as to why is it. You'd have to have a really good reason why it's the same. So it's typically you're going to come across companies that translate using a current rate. Now, remember I said it's not as easy as you would think in all cases to determine what the functional currency is, and I gave you the example of 2 companies, one the Toronto Maple Leafs and another an exporting company that operates at break-even. What's the functional currency? Well, here are 5 rules or 5 different things that sort of a checklist that you can go to determine what the functional currency is. The book gives you more, gives you 9. There are 4 more, but the other 4 really, I mean, if you can't figure out what your functional currency is by 5, you've gone too far, or you're just not thinking hard enough. 1 and 2 are the really big ones. 1 and 2. So let's see. The currency that mainly influences sales prices for goods and services. So let's take the Toronto Maple Leafs. Do you think that the American dollar is the biggest influence on what the Maple Leafs charge at the door to get in, or do you think the Canadian dollar is the bigger determinant? Being that everyone pays in Canadian dollars, you kind of have to set the price in Canadian dollars as well. As opposed to, now, if you set it in American dollars, you'd run into the situation where everybody coming to the game would be paying a different price all the time, depending on where the exchange rate was. How could you sell season tickets? So, being that number 1 is probably right for the Toronto Maple Leafs, right away we're leaning towards the Canadian dollar being the functional currency. What's number 2? The currency of the country whose competitive forces and regulations mainly determine the sales price of its goods and services. Well, inside you can buy alcohol. Well, guess what? That is a highly regulated substance in Ontario with lots of rules and licenses you need behind it, which means that you are subject to the regulations of the Canadian market and probably the competitive forces because, hey, if you're in Toronto, you got to compete with other venues, you got to compete with other sports, you got to compete with all sorts of things that you can do other than go to a hockey game. So number 1 and 2 right away would say, you know what? It looks like our functional currency is the Canadian currency. Let's go through these 2 again, looking at our exporter, who exports everything to the U.S. in U.S. dollars, pays all their expenses in Canadian dollars, and breaks even. The currency that mainly influences the sales price for goods and services. That's the U.S. dollar. That is the U.S. dollar right there. The currency of the country whose competitive forces and regulations mainly determine the sales price of its goods and services. Well, because everything is being exported to the U.S., it's the U.S. market that will determine the competitive forces in the U.S. market that will determine the price. And let's say we're making a particular product that has cleared all the regulations it needs to be sold in the U.S., but not in Canada. But we're not selling any in Canada. So let's say we're making a particular safety device that has FDA clearance in the U.S. but does not have clearance to be sold in Canada because the entire export is going to the U.S. The regulations in Canada don't apply. You can make something in Canada that is illegal to sell in Canada but perfectly legal to sell in the U.S. if you export everything to the U.S. So in that particular case, we could make the argument that, well, for the exporter, the functional currency is the U.S. dollar. So you see, number 1 and 2 can pretty much settle our problems, right? But let's have a look at 3, 4, and 5. The currency that mainly influences labor, material, and other costs of providing goods and services. Well, we said for the Toronto Maple Leafs, 1 and 2 indicated the Canadian dollar, but number 3 is indicating the U.S. dollar. For our exporter, 1 and 2 indicated the U.S. dollar as the functional currency. 3 is indicating the Canadian dollar, which is why we say 1 and 2 are the key ones. If 1 and 2, so for the Toronto Maple Leafs, 1 and 2 said Canadian, 3 says U.S., I'm still leaning Canadian. Number 4, the currency in which funds from financing activities are generated. So if the Toronto Maple Leafs borrow most of their money from Canadian banks to finance whatever they're doing, if they have any kind of banking relationship, as if it's in Canadian dollars, there you go. If it's in US dollars, it's still number 4 on the list. 1 and 2 really dominate. Number 5, the currency in which receipts from operating activities are usually retained, not earned. Not earned, but retained. So if our, let's say, our exporting company that's running on break even, that sells everything in the US, if it brings those US dollars back to Canada but does not retain them in does not retain them in US dollars but converts them into Canadian dollars to pay its Canadian expenses, if it borrows money from a Canadian bank in Canadian dollars, if it has Canadian expenses, well, we see that 3, 4, and 5 might indicate the Canadian dollar. 1 and 2 are indicating the US dollar. If it's mixed, management uses its judgment. So you might get to a situation where, look, I can make the argument that the functional currency is US, but I can also make the argument that the functional currency is Canadian. It is mixed. It uses its judgment, but it gives far more weight to 1 and 2. Far more weight to 1 and 2, and there may be a reason why it says, well, even though 1 and 2 are saying US, 3, 4, and 5 are saying Canadian, let's go with Canadian as being the functional currency. There might be a reason why. Anyways, that is the process you would go through for determining the functional currency of the subsidiary. That's the accountant's job, because the accountant has to then determine which road they're going down, temporal or current rate. All right, so we have a 3-step process. We've just described step number 1, identify the functional currency. There is a 3-step process to translation. The first step of translation is, let's identify the functional currency. Step 2, translate any foreign currency on the foreign entity's financial statement into the functional currency. And then number 3, use current Forex rates to translate the foreign entity's functional currency balances to the parent's presentation currency. That's why I said in LOSA, make sure you understand the vocabulary, because that's the language we're speaking right now, right? So I know there's a lot going on here. So let me go through it again nice and slow, and then we'll use some pictures to really bring it into focus. Step number 1, identify the functional currency. Typically, that'll be pretty straightforward, but sometimes there's a call. Once that's done, take the foreign entity, whatever the foreign entity is. If the foreign entity then has foreign currency, now foreign currency for the foreign entity is any currency other than its functional currency. Translate the foreign currency on the foreign entity's financial statements into the functional currency. Once that's done, then you can consolidate, which is what number 3 is doing. Use current Forex rates to translate the foreign entity's functional currency balances to the parent's presentation currency. Notice we're saying use current. So there must be something unique about step 3 that may not always need to be used. Because what if it's temporal? You wouldn't do that, right? So let's have pictures and let's have a look. Here's a relationship. Here's the parent, the US, that uses the US as its functional currency. And here's the subsidiary, which uses the Canadian as its functional currency. And it says right here, scenario number 1, the functional currency is the Canadian dollar here. But the Canadian company here does other business as well. It has euro receivables, let's say, and pound payables. That is called foreign currency exposure at the foreign entity level. This foreign currency exposure is at the foreign entity level. So we go on to step 2. Translate these foreign currency balances on the foreign entity's financial statements into the functional currency. So step number 1, identify the functional currency as Canadian. Step number 2, take everything on the financial statements here and put them all into Canadian. Translate all of these exposures into Canadian. And then step 3, convert it to US, translate it to US at the current rate. So I think we're seeing that if the functional currency of the subsidiary is different than the presentation currency of the US, we're going to use the current rate. Now we've already mentioned that. And there it is right there. We're going to use the current rate. Look over here. Here, the functional currency is the US dollar. So you have a US parent whose functional currency is the US, and you have a Canadian subsidiary, and even though it's Canadian, the functional currency is the US dollar. Let's do the same thing with this exposure. It has euro and pound exposure, but being that its functional currency is the US, it also has Canadian exposure from all its other Canadian stuff. So step number 2 says translate all of that to US. That would be the temporal method. Why? Because once you translate it to US, all you have to do is consolidate at this level because it's already translated. So the current rate is when you have to take the subsidiary statements and translate them to US. The temporal method is when you have to take the foreign, the subsidiary statements and translate those to the functional currency, which then simply just gets added on a consolidation basis. There's nothing to translate. If this is all in US and this is in US, you just add them together, right? So hopefully that picture sort of clears things up. In this situation, step 1, step 2, step 3 matches up with these 3 steps. In this situation, step 1, step 2, there is no step 3. See, step 3 says if different. You would only do step 3 if the functional currency and the presentation currency were different. Here they're the same. So there's only step 1 and step 2. Okay, from here on in, this is where it matters for us. So far, everything we've seen is more from an accounting perspective. That's what accounting students would learn up to that point, and then they'd go deeper in actually doing the transactions to account for that. We understand the broad strokes now. Current method, temporal method. We understand under which scenarios the current or temporal method would be used. It's not a matter of a parent deciding which one they want. It pretty much follows a routine. Here's where we need to pay more attention now. When the foreign currency is the functional currency, the entire investment is exposed. Remember, there are 2 scenarios now, right? The presentation currency could be the functional currency, or the foreign currency could be the functional currency. Here, for our subsidiary, the foreign currency is its functional currency. It is different from ours from a presentation perspective. Hence, the entire investment, all the assets and liabilities are exposed at that point. All asset and liability accounts will be translated at the current rate. Equity accounts at historical rates, except retained earnings. We'll do retained earnings at the end because it's a little tricky. And revenue and expense accounts are translated at a rate when the transactions took place. Because remember, an income statement spans a whole year. Well, some of those transactions took place a year ago when rates were different. Some took place 11 months ago, and 10 months, 9 months, 8 months. Typically, you use an average rate for the year to translate the income statement accounts. So the current rate, therefore, we end up with a translation adjustment, which is a separate component of shareholder equity. When we're using the current rate to translate statements, whatever translation adjustment we need to make the balance sheet balance after we translate everything, to make the balance sheet balance, whatever translation adjustment stays on the balance sheet. That's an unrecognized translation gain or loss. It doesn't go to the income statement. That is consistent with everything we know about unrealized gains. The cumulative balance quarter to quarter. The translation adjustment component is a cumulative balance quarter to quarter if the subsidiary is sold. The balance in the translation adjustment account, the balance is transferred to the income statement as a realized gain or loss. Again, consistent with everything we have. Under the current rate method, since assets typically are greater than liabilities, we have net asset balance sheet exposure. So any subsidiary or any parent that's translating subsidiary statements using a current rate method will have net asset balance sheet exposure. Thus, if the foreign currency appreciates quarter over quarter, there'll be a positive translation adjustment, which will lead to higher equity. If the foreign currency period to period depreciates, there'll be a negative translation adjustment. So as an analyst, forecasting brings in possible currency moves as well. So you have to look at the subsidiaries, you have to look at the amount of consolidation, the translation adjustment, and you have to think about, well, what happens now? Where do I think the currency rates are heading? Because this company is translating 5 different subsidiaries in 5 different markets using a current rate method, which means right away I know they all have net asset balance sheet exposure. So the translation adjustment will be positive under this type of Forex move, but will be negative under that type of Forex move. So at the parent level, part of your forecasting may now have to bring in the idea of where do I think these rates are going? What do I think is going to happen to these foreign currency translations? And it might be as simple as just saying, look, our parent currency is the presentation currency is the US dollar. I don't have to figure out where the other 5 are going. I just have to figure out, is the US dollar on a trade-weighted basis strengthening or weakening over the next period? Do I think it'll strengthen or weaken? Which means you got to pay attention to the central bank. You got to pay attention to monetary and fiscal policy. Remember economics, right? You did a level 1. You might be thinking, what do all these different subjects have to do with each other? How do we tie that into being an analyst? I don't want to be an economic forecaster. Well, you might not want to be an economic forecaster, but you're going to have to read economic forecasts for possible directions in currencies so that you can determine the impact on the translation adjustment on the parent's balance sheet. All right, so the last scenario we did, the last screen we spent some time on, was the foreign currency was the functional currency. Now, the presentation currency is the functional currency. In this situation, the entire investment is not exposed. Only assets and liabilities that are measured at current values are exposed, which means we could have a situation where you have net asset exposure or net liability exposure. It's more likely that you'll have net liability exposure because all your liabilities are monetary and would be measured at current rates, whereas not all your assets are. So it would be the opposite of what we just had. Instead of net asset balance sheet exposure, typically here using the temporal method, because this is temporal now, we would typically have net liability exposure, which would mean that we would benefit in the opposite direction on a currency move than if we use the current rate. So this is the situation. You have a U.S. parent and you have a Canadian subsidiary. The Canadian subsidiary is still required to keep all its books in Canadian. It's still a Canadian taxable reporting entity, but its functional currency is the U.S. dollar. So the first step is to translate all of these statements at this level to U.S. dollars. So a translation to U.S. dollars, GAAP calls it a remeasurement. You're just remeasuring this financial statement in terms of the functional currency before you consolidate. Under the current rate method, you have all of your Canadian balances and then you translate. Here we're translating first and then consolidating. So it's a little bit more complicated to do it this way. And because it's more complicated to do it this way, it also has a cost. From a company's perspective, the accounting for this has a very real cost. And because it has a cost, it makes it inefficient, which is a very good reason why the argument can be made that its functional currency is the Canadian and not the US. Why you would not want to use the temporal method, why you would want to use the current rate method. Because using the temporal rate method, you're going to see requires the books to keep track of a lot of different things, and that all adds cost, which means mistakes can be made, money has to be spent. It's inefficient to do it this way. It would have to be blatantly clear that this Canadian subsidiary's functional currency is the US. In other words, it would be difficult to argue that it's not, for you to have to use the temporal method. So I'm not saying the temporal method doesn't get used. I'm saying I don't think any accountant really cares for it or likes to use it because of the extra work that it adds. Let's have a look at everything you have to do here. All the monetary assets and liabilities, that's easy enough. You translate at spot at the balance sheet date. Look in the marketplace, look at the Forex quote, translate at spot, you're done. Non-monetary assets and liabilities that are measured at historical value at historical rates. That's still pretty easy to do. Number 3 is not. Non-monetary assets and liabilities measured at current value will be translated at the rate when the current value was measured. For inventory, that's a huge pain in the ass, which I will show you coming up. But that's a big deal because now you have to keep a record of the dates of every transaction and the rate on the date of the transaction as well, and the amount that it applies to on that date. So you can think of a company that has fixed assets that it adds to on a monthly basis, whatever it is, equipment, machinery, vehicles, buildings, whatever. Those are all at historical rates. So you would have to have a different historical rate for each time you bought one. There's number one. If you have inventory, depending on how you're buying inventory, you might have inventory spanning different, let's say you take weekly delivery of inventory. You might at some point end up with some components in inventory that have been there for 2 months. If you have 50, 60 different inventory items, some that have been there 2 days, some that have been there 1 month, you would need the current rate at the date that you bought them for each of those components. So even the historical rates can get difficult if you've got a lot of fixed assets. And the current rates can get very difficult as well. So we as analysts don't have to worry about that. That's the accountant's job to do that. I'm taking some time to point out that that has a very real cost. A very real cost to do. So I as an accountant, if I were an accountant looking at this, I would really go back and visit and see if I can't make the case that my functional currency is not the presentation currency. Please let me use the current rate method. Anyways, there we go. Shareholder equity, historical rates, again, except for retained earnings. We will see that. Now, here's where it gets really a real pain in the ass as well. We get to the income statement. Revenues and expenses translate at the rates when the transactions took place, which is typically an average rate, except for B. This is point A, except for point B. Now, let's have a look at point B and see how complicated that becomes. All right, so I've replicated point A up here, the revenues and expenses at rates when the transactions took place. Again, we can use an average rate. So you might think, well, that's easy. Just run right down the statement, translate everything at the average rate, except expenses related to non-monetary assets. Any expenses related to non-monetary assets, cost of goods sold, depreciation, amortization, are translated at the rates used to translate the related assets. So let's just look at inventory if you want a nightmare. Inventory, you can have FIFO, LIFO, or average cost. If you have FIFO on your balance sheet, you're measuring these at the most recent rates, whereas LIFO, you're measuring your inventory at older rates. Average cost, you're using average rates, which means your cost of goods sold for FIFO, if FIFO is being carried at recent rates, what you sold must have been sold at older rates. LIFO would have been sold at recent rates, average cost at average rates. Imagine you're Costco and you're in, let's say your subsidiary is in Australia with Australian dollars. Well, how many inventory items do you have? Number one, when did they arrive there? At what rate did they arrive there from? At what country, at what rate did they arrive there from? Imagine the nightmare you would have in keeping track of all of that stuff. And the accounting system you would have to be tied in to currency rates all the time, that when you entered something into inventory, it would capture the currency rate at that point in time so that you could recognize your cost of goods sold, because it's a non-monetary asset, at the rate used to translate the related asset. Wow. That turns into a nightmare. So just be aware that this is a huge expense to do. Here, look at what's interesting now. The translation adjustment, the gain or loss on this, on all of doing this, goes to the income statement. GAAP calls it a remeasurement gain or loss. IFRS calls it a translation adjustment gain or loss. It goes to the income statement, not the balance sheet. So that's different as well. Now it shows up on the income statement and it's going to mess around with net income. Now you've opened up net income to foreign exchange risk. Well, companies don't really want to do that at all. It's one thing to have it as a component of equity, because your analyst will figure, well, you know what, these will balance out. These will tend to cancel each other out over time. Unless a currency moves in one direction for an extended period of time, they tend to cancel out. But now that I got to hit my net income, so now I got to worry about hedging out all of that exposure. That adds another layer of costs. And is that wise to hedge out all that exposure? After all, it's really just a translation adjustment. It's not really a real exposure, is it? You can argue yes it is. Some can argue no it's not. It just gets very complicated very quickly. So I don't think you'll see much of this in actual practice unless it's impossible to get away from. Now, why does it go to the income statement? What's the rationale for making that go to the income statement, but under the current rate, it goes to the balance sheet? Remember, under the current rate, we said the entire investment is exposed, and the investment is made up of net assets. So all your assets and all your liabilities are translated, but it's the whole investment at risk, and until the investment is liquidated, it's always unrealized. However, here, your entire investment is not at risk. Only your monetary assets are at risk, and since those change on a regular basis, they're more likely to be realized in the near term. So since the functional currency is the presentational currency, then the foreign entity's monetary items denominated in a foreign currency will generate realized gains or losses in the near term. I know that sounds like a lot, but if you break down every part of this sentence, what it's saying is that, look, if I have my entire investment at risk, the only way it becomes a realized gain or loss is if I actually sell the entire investment. But if I only have certain monetary items on my balance sheet at risk, it's only going to be a matter of a number of days before the inventory turns over, before the cash gets used for something or new cash comes in. It'll always be turning over, which means they'd be realized at a much faster rate because it's only the accounts themselves that are exposed, not the entire investment. If that's the case, then send it right to the income statement. But I, as a parent, have to say, look, that's opening up my net income to volatility that I do not want. Mr. CFO, come over here. You got to go back to that accounting department, sharpen that pencil, and figure out if we can't use another method, which is typically what is done. All right, well, we're going to do the retained earnings account now just to see what's different there. But before we do that, let me just spend a few minutes making sure that we can cement the main theme as an analyst, the main thing we want to look at right away when we're dealing with international operations or companies with foreign subsidiaries. From a parent perspective, when you're looking at your subsidiaries, if the exposed assets are greater than the exposed liabilities, the parent has net asset balance sheet exposure from the subsidiary. If the exposed assets are less than the exposed liabilities, you end up with net liability balance sheet exposure. So, typically, companies that use the current rate will typically have net asset balance sheet exposure from all of their foreign subsidiaries. Those that use the temporal method will typically have net liability balance sheet exposure from all of their foreign subsidiaries. So when we're looking at the result of this, if you're looking at companies that report under the current rate method or that use the current rate method to translate their subsidiaries' foreign statements into the presentation currency, you're going to find it on the balance sheet, either positive or negative. It gives you some idea of the direction of the currency. And it does have an impact on total equity. But then you have to ask the question, is that in anybody's control? Was that really in management's control to be able to control the currency rates? And these are just translation adjustments. They're not gains or losses in the sense that net income is changing. They're translation gains or losses. No money changed hands. No cash flow was affected by this particular thing. So you may have some rule about how you treat that, whether it's important or whether it isn't. There's no rule about how you would look at it or how you would think about it. The only thing that you have to be aware of is, depending on the method used, current or temporal, depending on the direction of the currency, the strength of the currency, it'll throw your ratios off. So your ratios may not be comparable. You might want to adjust for comparability across there because of these things. Okay, let's have a look at the retained earnings account. We've held off on that till the end here. So let's take a scenario where we'll start with a company that starts off with nothing, and we'll follow it for 2 years just to see how we get to the retained earnings account. And we'll work our way down the subsidiary, and this is the net income, dividends, and retained earnings, all in the functional currency of the subsidiary, and then we'll look at translation. So In the first year, our retained earnings is zero, obviously. We'll have net income minus our dividend gives us a retained earnings at the end of the year, which becomes our retained earnings at the beginning of the next year. To that, we add net income minus our dividends. That gives us retained earnings at the end of year 2. That's fairly straightforward, right? Well, how do we translate all that? Well, this is the presentation currency over here. The first thing we're doing is we take the net income on the income statement from the subsidiary, and it's translated by the method used to translate the income statement. Whatever it happens to be, whether we're using the current method or the temporal method, we'll translate it with whatever method, and we'll get net income in the presentation currency. Here's the difference. The dividend. That is translated at the rate when the dividend was declared. At the rate when the dividend was declared. So you multiply the dividend by whatever the rate was on that date, and that'll give you the dividend in the presentation currency to give you your retained earnings. And of course, the ending retained earnings in the presentation currency is the beginning retained earnings for the next year. You add your net income in whatever method you use to translate the income statement. You have your minus your dividend. Again, the dividend is the rate at when the dividend was declared, and that'll give you your ending inventory. So retained earnings is kind of the same way, well, not kind of the same way, but you'll translate your income statement in whatever method that you want. The only difference with retained earnings over all the accounts is that you're using the rate on the date that the dividend was declared. So under the current rate, the entire income statement is translated at an average rate. The entire balance sheet is translated at the currency rate, at the spot rate on the date of the balance sheet, except retained earnings. That's the only thing you have to keep in mind, is that one component of retained earnings, the dividend, is translated on the date that it was declared. That's it. We'll see more of this when we do an extended example. I'll point out the dividend and how we've translated that dividend when we get there. All right, we're going to do an extended example here, which should cover off learning objectives C and E, which are both applied. And they're kind of out of order. C wants us to look at exchange rates affecting translated sales of a subsidiary and parent. That's just sales. We really don't get into detail on this in this reading. So that learning objective's out of place, but we're going to assume it means the income statement. How's that? E is looking at translation effects on the balance sheet and income statement, translating it into the parent's presentation currency. So C seems starkly out of place, and I've looked at the curriculum for both 2016 and 2017 to see if there was maybe something missing or something funny on that one, and I can't find where the detail is on that one. So why don't we just say, look, let's include it in with the income statement and be done with it. And really, it's not a big issue, so we'll go ahead with that. So let's set up our scenario, and I'll walk you through it. I'm not going to use the black screens. I'm just going to use the white screens here. I've tried to replicate as best I can everything from the chapter. So it should, if I retyped in numbers wrong, don't get excited. It's just the same thing. Whatever you see in your book, that's it. I'm really going to narrate the relationships, not so much the exact numbers. But Interco is the parent. In this relationship, Interco's presentation currency is the euro. You should be very comfortable with the vocabulary now. Its presentation currency is the euro. Canada Co is the subsidiary. Its functional currency is the Canadian dollar. So we're going to have a translation issue. Now, can you tell right away what type of translation we'll be doing? Since the presentation currency and the functional currency are different, we should be using current rate. Exactly. And let's say the subsidiary was established on January 1st, 20X1. So here's the balance sheet on January 1st, 20X1. It was capitalized, it looks like, with 1.5 million. This is all in Canadian dollars, so whatever the exchange rate was on the euro at that point, it bought 1.5 million Canadian. Looks like the company negotiated a loan of $3 million, and with that bought property, plant, and equipment, or property and equipment for $3 million. There's the 1.5 sitting in cash. Total assets of 4.5. Total liabilities and equity of 4.5. That's January 1st. Throughout the year, this is the income statement for December 31st, 20X1. We can see sales all the way down to net income, and then we have a retained earnings component down here, less our dividends for the year and retained earnings ending amount for December 31st. So this is what we started with. This is the income statement that happened during the year. Let's look at the balance sheet we have at the end of the year. Okay, here's the balance sheet as of December 31st, 20X1. This is what we're working with. I'm not going to go through each account. You can see what's here. The important thing to note is it is all in Canadian dollars. So we have at the December 31, we should have an income statement in Canadian dollars, a balance sheet in Canadian dollars for the subsidiary. It's its functional currency. It's also its reporting and its presentation currency within Canada. And the retained earnings of $830 is right off the income statement. Here are some currency rates we're going to need going forward. We're going to need a rate for January 1st, 20X1 because that's the date we capitalized. It was 70 cents. This is euros per Canadian dollar. So what this means, it's how many euros we're getting per Canadian. So that means 1 Canadian dollar is buying 0.7 euros. The average throughout the year, the average rate was 0.75. Now look at this next line. I'm drawing your attention to this because there's always some confusion when it comes to this, that if we're using an inventory system that is weighted average, we simply use the average currency rate. No, we do not. There's the average rate. There is a weighted average rate when inventory was acquired. All right, so it's a different rate than the average rate. So if we're using average rate inventory method, then we would use the weighted average rate when the inventory was acquired. That is 0.74. The average for the year was 20X1 was 0.75. That's what we would convert sales at. December 1st, 2000X1, this is when dividends were declared. Remember, we need that for the retained earnings account, 0.78. And December 31st, 20X1 is 0.8. So if we were going to put some labels on these things, that is C, that would mean that is the current rate. H, that would be your historical rate. A, that is an average rate for the year. This is just an average rate for inventory, so we'll put AI on there. And this is when dividends were declared. That is the current rate for dividends. So if we wanted to just label them just to see what's going on, you're not going to find A sub I and C sub D in the book. This is just something I do just to keep it straight in my head. I see current, that's the current rate for dividends. A is the average rate for inventory. There we go. Let's move on. Okay, let's look at translating these statements. We'll start with the income statement. And we're going to do it under two methods. We're going to assume that Canada Co's functional currency is what we believe it to be, the local currency. Which means the scenario that we looked at when we first set up 2 screens ago, saying it looks like a current rate situation, is right. It is a current rate. We'll do that. But the point of this is to demonstrate the difference between the two methods. So we're going to also assume Canada Co's functional currency is the parent's currency, is the euro. So we'll use the temporal method. Now we're starting with the income statement. That's a bit of a problem for the temporal method. It's not a problem for the current rate method, simply because that is where you start. Notice what I say at the bottom. The income statement is translated first. The retained earnings of 612 is then transferred to the balance sheet. So we need a retained earnings amount to do the balance sheet. For the temporal method, we start at the balance sheet first. Now you may say, but how are you going to get the retained earnings for the balance sheet? It's very simple. You do the balance sheet, and retained earnings is whatever you need it to be to make it balance. Why? Because the translation gain or loss shows up on the income statement. But since we don't know what the translation gain or loss is, what we're missing is the retained earnings account. The retained earnings must be what is required to make the balance sheet balance. So from there we can put the retained earnings in and then work our way up to solve for the gain. It's a messy way to do it, but that's the way you have to do it. So let's start with the current rate. Look at the simplicity of this. The average rate, everything from top to bottom, all the way down to you don't even need to calculate the income before the translation gain, because if you translate everything at the same rate, the income account will translate at the same rate as well. So it's 0.75. It's the average rate for the year. Recall now, I made a point of saying we have an average rate for the year, and then we have an average rate for inventory for the year. This is the average rate for the year. Even cost of goods sold is the average rate for the year. We don't even have to think. Current rate, everything. Done. Period. So we get to 885. The translation gain or loss, where is it? Well, it doesn't show up on the income statement under the current rate. It's a balance sheet account. We can just ignore it. So there's no volatility in net income period to period because of these translation gains. It's a clean number. Remember that. It's a clean number. So our net income after translation gain is exactly what it is before because it doesn't matter. Then we have our dividends, $350,000, but the rate on this date that it was declared is 0.78, so we translate those dividends at that rate for 273. We get 612 euros, 612,000 euros for retained earnings. That gets transferred to the balance sheet, and we'll look at the balance sheet in a few minutes. Let's look at the temporal method. Now, for the temporal method, you had to do the balance sheet first, and when we got to retained earnings, you simply put a number into retained earnings, whatever it takes to make the balance sheet balance. That becomes your bottom line over here. What is missing is this number right here, is the translation gain or loss because it shows up on the income statement. We don't know that. We can work our way all the way down to income before the translation gain. We don't know what that is. So once we get to here, we go to the balance sheet. We translate the balance sheet. We figure out what we need in retained earnings to make the balance sheet balance. Then we start at the bottom. And then we can convert our dividends. That's easily enough. So we know what the income was after the currency gain or loss to get this number. And then from that, we can impute what this balance was. So you kind of have to go down, jump to the balance sheet, come back, and work your way up on this one. So let's have a walk down and see what happens. Sales at the average rate. That makes sense. Sales happen every day. Cost of goods sold, 0.74. This was the average rate or the historical rate on the dates that inventory was purchased. It's the weighted average rate for the currency over the period of the year on the dates that inventory was purchased, 0.74. Selling expense, the average rate, because selling expenses happen all year long. Depreciation, 0.7. Remember, we bought that building on January 1st, the day we capitalized. And we used, and the exchange rate at that time was 0.7. So the depreciation on that asset, if the asset is measured at 0.7, the depreciation has to be measured at that rate, so we use 0.7. Interest and income tax both have the average rate for the year. So we're using an average rate, a weighted average rate for inventory, a historical rate for depreciation. We get to 990. Notice that our income here, before any gain or loss, is actually higher than our income here. However, we have this loss. Now, we don't know what it is. We don't know what it is. So we run to the balance sheet. We figure out what we need to make it balance for retained earnings. 472, we put that in. We still convert our dividends at 0.78. We add these two together, we get 745. We can figure out that it was 245. Now, here's the thing that you want to pay attention to. Our net income under the current rate approach, 885. Is larger than 745, roughly some 16, 17, 18% larger because it doesn't hit the income statement. The translation gain or loss will not hit the income statement. So it's easy enough to see that this has a translation loss. If the translation loss didn't hit the income statement on the temporal method, you'd have 990 versus 885. Again, you still can't compare them. Now we're translating the same statement just in two different ways, and we're getting two different numbers out. You can tell that it's going to be hard to compare ratios on that respect. Let's have a look at the balance sheet. All right, so under the current rate method, look what's going on. 0.8. What's this exchange rate? Where was this exchange rate from? Well, the balance sheet is as of a specific date. So this is the rate on that date. It is the spot rate on the balance sheet date. Look how simple this is. Again, imagine yourself in the position of a CFO and you're asking yourself to weigh the costs and benefits of using a current rate versus temporal rate. I think you would have to be pushed very far to adopt the temporal rate. In fact, you would only, as I said before, you'd probably only adopt the temporal rate when it would be very hard to argue that you should be using the current rate, only because of its simplicity. And the beautiful thing here is that gain or loss does not affect net income. You reduce the volatility of net income. You want what's reflected in net income to reflect what management is capable of doing. Management is not capable of engineering an exchange rate. You want to try to bring that out of there. So again, I doubt you'd see temporal very much out there. That doesn't mean it doesn't exist. It's just I doubt it. Not that I doubt that it exists. I doubt you'd see it very much. Anyways, look at this. Look at the beauty. 80 cents all the way down, nice and simple. Notice that when we get to capital stock, it's the historical rate at the date that it was capitalized, 0.7. And the retained earnings is simply transferred from the income statement. And all we got to do is figure out what we need to balance. Notice we have a gain. Well, what does this gain do? Look at the size of our equity here under the current rate versus the size of equity under the temporal rate. Now you may say, well, there's more equity here than there's here. Well, true, but what's that going to do to our return on equity? Obviously, the temporal rate may show a larger return on equity because it's got a lower equity. But also remember, it had a much lower net income as well, right? So you got a numerator that's different, you got a denominator that's different. How are you gonna compare these things? We're gonna get into that. Also, look at the asset, 4.6 million versus 4.2 million. We have a larger asset base as well. Larger asset base because we have larger equity. Now, it just so happened that this was a gain. It could have easily been a loss, and this would have been changed around altogether, which means you may end up with a situation where our assets here are lower than the assets there, and still making it difficult to compare. So there's no one way where we can say, well, if it's this way, you're fine, but if it does this, it's not. There seems to be, when we get to the ratios, you'll see that there's really no one direction or rule that they can go in. But this is nice and simple. The income statement was simple. It's the average rate. We're done, except for dividends. The balance sheet is simple. What's the exchange rate on the date that you did the balance sheet? Do it all. And also keep on your balance sheet whatever the gain or loss is. It's so simple. Now let's go over to the temporal method. So if it's a monetary account, we'll use the spot. Cash is monetary, accounts receivable is monetary, but inventory is not. We must use the average method of the rates when inventory was purchased, 0.74. Property plant, we must use historical cost, less accumulated depreciation. We know that's historical as well. Accounts payable is a monetary liability, that's spot. Long-term notes payable, that is spot as well. Notice that there are only two balance sheet accounts that we do at spot for roughly about 1.5 million. But almost all your liabilities, well, in this case, all the liabilities are monetary liabilities. So when we look at the temporal method, it is quite common that the subsidiary will typically always have net liability balance sheet exposure, and under the current rate, it's pretty typical that the subsidiary will always have net asset balance sheet exposure. So we go down, we get to 2.7 for liabilities, we translate our capital stock at the historical rate of 1,150,000. Then we have to figure out, well, we got a balance to 4282, so let's put 4282 in. There's no translation adjustment that belongs here, it belongs on the income statement, so we need a number to balance, that's in retained earnings. So for retained earnings, we don't calculate that from the income statement, then bring it here. We impute it from trying to make this balance. We impute that here, and then we run that over to the income statement and work our way up to get the translation gain or loss. Again, that's difficult and cumbersome. It's more work. So, and we're going to move on to look at the ratios now, and we're going to see that when we use the current rate, many ratios are very, very comparable to what the original currency was. Calculating the rate in the Canadian currency or calculating it in the translated currency, we're going to find that if the numerator and denominator were from the same statement, nothing changes. Let's have a look at that. All right, so here are the ratios, and we have three columns here. This is the Canadian dollar column. This is what they would be on the subsidiaries' statements. If we use Canada Coast functional currency as the local currency and convert at the current rate into euros, this is what we would get. And this is if we use the temporal method. Notice for the current ratio, they're the same using the current rate. If we translate with current ratio the same, debt to assets the same, debt to equity the same, interest coverage the same, gross profit margin. In fact, they're all the same. It's because the numerator and the denominator are both from the balance sheet. These are both from the balance sheet, both from the balance sheet. All of these down here, the numerator and denominator, are all from the income statement. And we've translated each of these amounts. We translated the balance sheet, all accounts, with one rate, and we translated all of the income statements with one rate. So we will preserve the relationship between these ratios. When the numerator and denominator are from different statements, however, the current rate isn't going to give us the same relationship. But the majority of the relationships are preserved. Not so for the temporal. 684 versus 664. 0.52, 0.56, 1.29, 1.58, 722, 774. Now, we don't have to go through each one and look at whether it went up or whether it went down. Here's the rule. You don't know. There is no rule as to, well, if it did this, then it goes up. If it did that, then it goes down. It could be anything. It could go in one direction or another direction. You really don't know. Some things that we can say: ratios will differ when different rates are used under each method to calculate the numerator and or the denominator. If you have different rates for the numerator and or the denominator, then they'll be incomparable between and among. So, for instance, to be very clear what we're saying here, if we have the current ratio, let's say that for this it was the balance sheet, so we use the same ratio, the same conversion rate for the top and for the numerator and the denominator. If we had a ratio where one came from the balance sheet, one came from the income statement, we're using different rates for a numerator and denominator. The local currency relationship will not be held with the current rate. Between the current and the temporal, where they do differ is when, this is a balance sheet account, is when the current rate uses one rate and the temporal rate will use another rate. Even if it uses the same rate for current assets but a different rate for liabilities, then yes, it will be different. Ratios from the functional currency to the current rate ratios will mostly be preserved. Let's look at another set of ratios where it is not preserved. All right, let's look at this set of ratios we have here, and what's unique or what's different about this set of ratios versus the ones we looked at is here we have a numerator and denominator that come from different financial statements. For instance, our first one, our numerator is the income statement, our denominator is the balance sheet, all the way through. So the relationship is not going to be preserved even under the current rate, because the income statement, recall, we used an average rate of 0.75. The balance sheet, we used a current rate of 0.8. So they won't be preserved in that respect. And here's the disheartening thing in all this, is that there is no rule. There is no rule saying, well, under this scenario, current rate ratios will be more than temporal rate ratios, or will be less than if this. There is no rhyme or reason to why it could be any one way or another. For instance, we look at receivables turnover. The temporal and the current rate produce the same thing. Go to inventory turnover. The temporal rate is higher. Fixed asset turnover, it's higher. Return on assets is lower. On the other hand, return on equity is higher. There's no rule that you can put in place that says, well, if it's this, then this will happen. It's really sort of an unknown, which makes it kind of hard to use the temporal method, because while the current rate method does have some problems when you use a numerator and denominator from different statements, if you don't, there is no issue. But with the temporal method, there is an issue no matter what you use. And we saw that it's complex, it's detailed, it's a lot of extra record keeping on rates. So again, you want to think about that. Now, if you do run up against anything that does have a company that is using a temporal method, you're going to have to be very aware that you're not going to be able to compare it with other companies that use current rate method. It's going to be difficult to compare, and it's going to be difficult to back out. The best you can do is say, well, here's what I'm going to do. That gain or loss that's on the income statement, a first step would be to get that out of there, and let's throw that into the equity section. Let's just modify equity and modify income and then recalculate ratios and see what that gives me. That might be the closest you'll get to comparing it, because it's going to be hard to go back and retranslate any of those amounts given with different rates to try to get comparability. But depending on the information that you have available, you might be able to. But if you're dealing with a parent that has 12 subsidiaries, and let's say 4 of them are using temporal, 8 of them are translated at current, and another one has 12 subsidiaries where it's the other way around, oh, that's a nightmare. That would just be an absolute nightmare, and you might be doing a lot of work to gain very little new precision. So there's always a trade-off, even in doing work like this, where you have to say, yeah, the right thing would be to try to right-size all of these things for the same currency, but that might take me 2 weeks to do or a week to do, and it might add very little incremental new knowledge. So you might just work with, okay, I have 8 companies using the current rate method, so I know that 8 have net balance sheet exposure, or net asset balance sheet exposure. What currencies are they? Where do I think those currencies are going? The other 4 probably have net liability balance sheet exposure. What currencies are they using? Where do I think those currencies are going? And sort of project what you think the currency translation will be. Will it be positive or negative? Will it contribute or will it take away? And I think that at that level you're doing quite well. All right, let's look at the situation where a foreign entity is operating in an economy facing hyperinflation or highly inflationary environment. If a foreign entity is in such an environment, chances are the currency of that country is depreciating very rapidly. And if that's the case, then if you try to translate those financial statements using that exchange rate, you'll find that assets that were worth something last year are worth almost nothing this year, will be worth even less the next year. They'll simply just disappear from the balance sheet. So there's got to be a better way to do it. So let's look at IFRS and GAAP. IFRS says the foreign entity's financial statements would first be restated for changes in the local general price level. Then translated at current rates. And that can sound a little bit confusing. What do you mean? When we say the local general price level, we mean the general price level in the country where the subsidiary is, where the foreign entity is. And when we say that you restate the amounts, remember, we record everything on the books at historical cost. Even though we have inflation in every country, we still record things at historical cost. We don't restate them every year for a rise in the price level. But this is what IFRS is calling for in these situations. So here's the situation. Let's say that we have a 25% inflation rate over the year, and we buy some land or an asset or a building or whatever the case is for $1,000. When inflation is at this extreme, IFRS is saying, well, you know what you need to do? You need to restate this amount for that level of inflation. So restate it at $1,250. Now use the current rate. And the thinking here is that if you're in a highly inflationary environment, there's no sense in converting a historical amount by this really, really low current rate. What you'd want to do is say, well, listen, if it's in a highly inflationary environment, if we did sell it, chances are it would sell at the rise of inflation. So let's correct it for inflation to see what it would be in the inflationary dollars, and then use the lower rate. So the combination of writing it up by the level of inflation and translating it by the lower rate of the currency will give us a better picture of what the value is. That's IFRS. GAAP says, you know what, just use the temporal method. Nice and simple. So this is the temporal method over here. Let's say over a period of time we have the 25% inflation. We paid $1,000 at one particular time. You keep using the historical rate so it never changes. And there you go. GAAP says just don't mess around with the inflation. Just use the historical rate and be done with it. Brings up the question: what do you mean excessive inflation? At what rate of inflation do we actually use these policies? And it is a 3-year thing. It's 1 plus I being the inflation rate to the power of 3 minus 1 must be greater than 1. So what this is saying is, like, if the inflation rate were about 26%, it would be 1.26 to the power of 3 minus 1 would be greater than 1. Or, in more simple words, the compounded inflation rate over 3 years is greater than 100%. Then you would use these methods. All right, let's use an example. We'll set up a timeline here, and we'll look at using the temporal method, and we'll look at the IFRS method. So we'll look at GAAP and IFRS here. This first timeline is just our example, and this is Turkey between January 1st, 2000 and December 31st, 2002. The Turkish lira on January 1st, 2000 per US dollar for each US dollar was 542,700 Turkish liras per US dollar. On December 31st, it was 670,880. December 31st, 1.4 million, then 1.7 million by, or close to 1.7 by December 31st, 2002. So over the first year, from January 1st to December 31st, inflation clocked in at 38%. During the next year, inflation was 69%, and here it was 45%. So if you compound all these, it's greater than 100% over 3 years. It qualifies for being in a hyperinflationary environment. If we were going to use the current rate, just to show you why the current rate fails in this method and why the currency is irrelevant, let's translate this original $1,000 asset that we purchased on January 1st at this exchange rate at the new exchange rates. If we restated it or converted the $1,000 at the current rate at December 31st, that 1,000 is now only 809 in the U.S. currency. That's 1,000 U.S. That's 809. By the next year, it's only 368. By the next year, it's 325. So you can see that the asset is just going to disappear off the balance sheet as inflation continues. And if you look at your gain or loss, you have 191 in this year, 441, 43. Your cumulative gain or loss, see, by the time you get to the end of the second year, 675. So clearly, this does not present a valid picture of what the value of the asset truly is. So the current rate it's meaningless to use the current exchange rate. So if we use the temporal rate, which is a historical rate, here's what it looks like. $1,000, if one US dollar was 542,000 Turkish lira, then it's 542,700,000 Turkish lira. It would never change. You'd translate this $1,000 at that historical rate, and the next year you'd do the same thing, and on and on. So there'd be no gain or loss, no cumulative gain or loss. So the temporal, you'll recall, says use the historical rate for assets that are recorded on the book at a historical rate. Keep using that rate. This is required by GAAP. All right, let's look at IFRS. The two top timelines are exactly the same as before. The only thing we have to look at is the bottom timeline. And this is how IFRS would do it. We start with 1,000 at the original value of 542 million Turkish lira. You'd multiply this by 1.38. You'd multiply the exchange rate by 1.38 to get 748. That's the value in Turkish lira that it was purchased at, 748. Multiply that by 69% to get 1.2 billion. Multiply that by 1.45% to get 1.8 billion. You know, at some point, it's just ridiculous to write, like, that's $1,000, 1,835,000,000 lira. That's just ridiculous. At some point, you think that you'd restate the currency in some other denomination, right? But there it is. And then what you do, so let's take our initial $1,000 at the initial value in Turkish lira. You increase the value of the Turkish lira by 38% to 748. Then you take this and you divide that by the current rate at that time, 670,880. So you divide by 670,880, you get 1116. So now what we're saying here is that given that there's been inflation in that country, let's say we bought something for 542 million lira on January 1st. If the inflation rate was 38%, then by the end of the year, if you were going to restate that asset in fair value terms in Turkish lira, it would be 748 million. So IFRS says, well, then use that number and then convert at the current rate at that time. And the current rate at that time is 670,880. So you divide this by, because 670,880, that's $1 US in Turkish lira. So how many US dollars is this? 1116. So you have a gain of 116, cumulative gain of 116. That is probably right. Think about it this way. We bought this on January 1st. What if we sold it on December 31st? Chances are our selling price would reflect inflation, the 38%. Chances are we'd get this much Turkish lira. And if this is the current exchange rate, it would exchange back into this many US dollars. So that makes a lot of sense. Well, next year multiply by 1.69, so that if we sold it on December 31st, 2001, given that we had 38% inflation followed by 69, that asset should sell for 1,265,000,000 Turkish lira. And if the exchange rate is 1,474,000, if we divide that to see how many US dollars it is, it's 858. Now we have a loss. You have a 258 here, 250 and 142. And then you do the same thing in the third year. If inflation was 45%, multiply it by 45% to get what the fair value is in Turkish lira, convert it at the current exchange rate, and figure out what it is in US dollars. There's a little bit more stability along here. GAAP gives the most stable number by saying it's 1,000 no matter what, because you're going to use the historical rate. IFRS says, let's not abandon the current rate. Let's not abandon the current rate. Notice we're still converting at every period at the current rate. It's just saying, don't abandon the current rate, but restate the assets for inflation. If inflation is inflationary, is hyperinflation, just restate the assets and then use the current rate. And this is required by IFRS. If you want to read more about it, IAS 21. All right, so let's look at the actual process here. For GAAP, what's the process? Temporal method. We already know the temporal method. You get to a hyperinflationary economy, it's the temporal method, period. IFRS, let's look at how we deal with the balance sheet first. Monetary assets and liabilities are not restated for inflation because they probably are already inflation adjusted if they're monetary, right? So they are exposed to gains or losses in purchasing power. Therefore, they give rise to gains or losses on the income statement. So monetary assets are not restated. Non-monetary assets and liabilities are restated for inflation. Restated from the date of balance sheet valuation or from the revaluation date. We can buy a building, you learned this in level 1, you can buy a building for $1 million and 3 years later you can restate it at fair value under IFRS. If fair value is significantly higher or lower, you can restate it. So you would translate the asset or liability amount from the date that it hit the balance sheet, that what price did it enter the balance sheet at, or from the revaluation date. For equity accounts, all components are restated for inflation from the beginning of the period. And since you're doing it year over year over year, you really only have to do this for 1 year at a time or 1 period at a time. Now, let's be clear, all components are restated. We had learned before that we don't touch the equity accounts at all. We just have a little funny thing we have to do in retained earnings with the dividend, but beyond that, we don't convert, we don't bother with the current rate on equity accounts. Well, here, all components are restated for inflation. All of them are restated for inflation. If you take the non-monetary and the equity accounts, and you adjust them for inflation, what you're doing is you're keeping the purchasing power of the value of the asset constant. It is stated at its initial purchasing power, and I just shortened that to PP. The income statement, what do? All income statement items are restated by applying the change in the general price index from dates when the item was originally recorded on the balance sheet. So if you're talking about depreciation or inventory or amortization, and the net gain or loss from holding monetary assets also shows up here. Notice for the balance sheet we had our monetary assets, because they're not restated for inflation, are exposed to gains or losses in purchasing power, which gives rise to a gain or loss on the income statement. That's the new entry on the income statement here, is a gain or loss from holding the monetary assets. So if we are holding monetary assets during periods of inflation, you will have purchasing power loss. It is like sitting on money. If you have money and you don't keep it in any kind of savings account that's going to grow at least the rate of inflation, let's say that you're old-fashioned, you don't trust banks, you don't trust the system, you got all your cash in a brown paper bag under your bed. Well, every year it loses purchasing power because you're holding a monetary asset, right? So you'll have purchasing power loss. If you're holding monetary liabilities during periods of inflation, you have a purchasing power gain because your debt does not grow at the rate of inflation. It actually shrinks away at the rate of inflation because hopefully your wage is tied to inflation. So in inflationary periods, you'll make more and more money. You'll have the same purchasing power, but your debt will become cheaper and cheaper to pay off because it does not appreciate. Now you can understand, or at least start to lean towards the understanding of, why do governments who are heavily indebted prefer a central bank that pursues inflation? Because they have purchasing power gains because they can inflate that debt away. All right, let's look at a scenario here. Let's say that we'll look at our balance sheet on January 1st here. Capital stock of $5,000. We put $5,000 into, this is in the foreign currency. So we have $5,000 in the foreign currency. This is our subsidiary. We borrowed another $5,000 in the foreign currency for $10,000. We bought some land for $9,000. We have cash for $1,000. This is our initial setup. That land we rented out for the year. We have rental revenue of $1,000, interest expense of $250, net income of $750. So as of December 31st, this is what our income statement would look like. If we have net income of $750, our cash is higher by $1,750. Our land is still listed at $9,000. So our total assets are $10,750. We still have the note of $5,000 because all we did was pay interest. There's our capital, and our retained earnings, $10,750. There's our scenario. Let's throw some inflation in there and let's see what happens. All right, let's look at the IFRS example first because it's the a more detailed one. We first have to take the income statement and the balance sheet at the end of the year and restate it for inflation and then translate it for the current rate. All right, so let's set up our scenario. January 1st to December 31st over the course of the year. The general price index, we started the year at 100. It ends at 200. The average for the year was 125, indicating that a lot of the rise in inflation came near the end of the year. The exchange rate at the on January 1st was par per US dollar. We got $1 of the foreign currency. And the exchange rate at the end of the year is 0.5. The average for the year was 0.8. Notice that this is a symmetrical move. The general price index increased by 100%. The currency dropped by 50%. So we'll see that the net income we arrive at under both IFRS and GAAP for this scenario will be the same because it's symmetrical. The theory of purchasing power parity says that that's what should happen. Unfortunately, that rarely or never happens, and when it does happen, it's purely just by chance. There's nothing in the marketplace that says that there is a rational and good reason why, because there's no arbitrage opportunity to make it so it's not subject to that type of pricing. So this example is really just a stylized, idealized example just to show the process, but it is one that conforms with what purchasing power parity would say, even though that never, ever happens. Yet we have a theory for something that never happens. Kind of makes you wonder what economists in universities are doing there, right? All right, let's begin. Here's our balance sheet, cash, all the way down to our below retained earnings. We have our total, and then we have our income statement immediately before that. This is what we ended the year with at December 31st in the foreign currency. So now we're going to restate it for inflation. Our monetary assets and monetary liabilities we're not going to touch. So cash is monetary, a note payable is monetary, so $1,750 stays at $1,750, $5,000 stays at $5,000. Everything else we're going to translate. So if we end the year at a GPI of 200 and we start the year at 100, that's a doubling of the price index. So the price index doubles, so all we have to do is just double the value of everything we have. If this were 300, the price level would have tripled. We'd just multiply by 3 everything we have. So 9,000 becomes 18. 5,000 here. Notice what we're doing with the capital stock. We're also doing that. That becomes 10. This is not a currency conversion or a translation. This is just a restatement for inflation. So everything gets restated. Here's the little funny part is for retained earnings, how do we know what that number is going to be? And this is where we have to, it gets a little clumsy on the balance sheet. We know we have 19,750 in total assets, so we have to have 19,750 here. Since we have 15,000, we would just work our way backwards and say that must be 4750. It must be 4750. So let's go to the income statement now. The income statement will be translated at the average general price index level, which is 125. So it'll be 200 over 125 instead of 200 over 100. So 1,000 becomes 1,600. 250 becomes 400. We have 1,200. Now, we don't know what the purchasing power gain or loss is. We're at 1,200, but we do know that our retained earnings is going to be 4,750. So from that, once we put 4,750, we can work our way backwards and get 3,550. It's clumsy. It's just clumsy. But you're just really getting a high level view of the process here. There's our inflation adjusted balance sheet and income statement in the functional currency or the foreign currency. Apply the exchange rate to every single account now. Notice we're applying it to every account. and here's what you get in US dollars. We get 23.75. So this is the easy part. You just have to remember, hey, listen, when I'm dealing with an inflation-adjusted statements, I must use the current exchange rate on every single account, every account. Notice that by doing that, whatever relationships exist here will be preserved once you translate it into the US dollar. And of course, your purchasing power gain or loss is translated as well, 17.75. And notice we have a gain on that. Does that make sense? Think about that. Should we have a gain in purchasing power on our US dollar income statement? Well, remember now, if we're holding monetary assets, we lose purchasing power, and if we're holding monetary liabilities, we gain purchasing power. So do we have a net asset or net liability exposure in this situation? Our cash is $1,750, our note payable is $5,000. We have more monetary liabilities than we have assets. So remember, that relationship we learned earlier still holds for this situation, is that will benefit us because we have a more indebted, or I shouldn't say indebted, but we have a subsidiary in an inflationary environment that is holding more monetary liabilities than assets. We will get a translation gain for the purchasing power gain when we go from the inflation-adjusted statements to the presentation currency. All right, let's have a look at how GAAP takes care of it. GAAP just uses the temporal method. Simple as that. So all monetary assets and liabilities will be translated at the current rate, and all non-monetary assets and liabilities will be translated at the rate at the time at which the asset or liability showed up on the balance sheet. So cash is monetary, current rate, 875. Land is non-monetary, historical rate. The note payable is monetary, gets converted at the current rate. And the capital stock is non-monetary, gets converted at the historical rate for $5,000. So how do we do this? We got 98.75. So what we do is we put 98.75 down here. We've got 7,500, and we can then impute this value. We translate the revenues and expenses at the average rate for the year, 0.8. That gives us 600. We know that our retained earnings was 23.75, so we'll bring that number down here, and we can impute the gain or loss here. We have a translation gain. Does that make sense that we should have a translation gain? It certainly does. The currency is depreciating, because now we're not talking about inflation, we're talking about the currency, right? The currency is depreciating, but our statement has net liability exposure. Our balance sheet has net liability exposure. We're translating $5,000 of liabilities, but only $1,750 of cash. Since it's depreciating, we would get a benefit from that, and there it is, right there. There's inflation. So we'll turn our attention now to the effective tax rate, the parent's effective tax rate, and the effect on the statutory tax rate that operating in different tax jurisdictions would have. And that's, of course, how we get to the effective tax rate. So multinationals will incur taxes in the country in which profit is earned. So if we have an American parent that has a Canadian subsidiary, the Canadian subsidiary is still a legal Canadian taxable reporting entity. It still must file with CRA, and it still has to pay its due to CRA. It's got to send its check in Ottawa. But the parent will get credit for those taxes that are paid. So let's go through this nice and slow. Let's take a situation like this where we have a parent that has a statutory tax rate of 35%, has two subsidiaries. Subsidiary 1 is in a jurisdiction that has a statutory tax rate of 25%. Subsidiary 2, 20%. So where would we like to earn the majority of the profit? We'd like a situation where the parent and subsidiary 1 break even, and subsidiary 2 pays all the taxes, right? Because that's the lowest tax rate. We call that the low tax jurisdiction. Well, there are transactions called intercompany transactions that could achieve that goal, where the parent and the subsidiary 1 could transfer some of their profit to subsidiary 2 by setting up an intercompany transaction with a price that specifically allocates more of the profit to subsidiary 2. So we can think of subsidiary 2 as perhaps providing design consultation to subsidiary 1 and the parent. Perhaps they're designing something, or what you call it, anything you want. And the parent and the subsidiary 1 pay these huge fees to subsidiary 2 for that consulting fee, for that design consulting fee, thereby incurring extra costs at these levels and transferring much more profitability to the low tax jurisdiction. So transfer prices on these transactions, on intercompany transactions, can affect the allocation of profit. And as I've said many, many times, if there is an opportunity for this kind of behavior, it will be done. It just will be done. So, companies may set transfer prices so a higher portion of profit is allocated to low tax jurisdictions. And because it will be done, if it can be done, there's typically regulation regarding non-market transactions. An intercompany transaction is a non-market transaction. So there'll be some scrutiny applied to those transactions to determine how out of line they are from market transactions. And if it's perceived by the tax authorities in the parent country that it is engaging in intercompany transactions specifically for the purpose of shifting profitability to lower tax jurisdictions, slam, they're going to get knocked down, and a nice hefty fine for that as well. Most countries will hold tax treaties that prevent double taxation. If there wasn't, you certainly, a parent would never consider opening a subsidiary in a country that did not have a tax treaty, because you would have double taxation at that point. So they grant credit for tax paid in another country. So under that kind of system, you'll always pay your highest tax rate. If your parent has the highest tax rate, you'll always pay that tax rate. So let's be clear on that point that I just said. If the home tax rate is greater than the foreign tax rate, the incremental tax rate that the parent would pay, we're assuming the parent is the home tax rate, is the home tax rate minus the foreign rate. So let's say that I'm the parent and I'm in a jurisdiction that has a 35% tax rate, and I have a subsidiary in a tax jurisdiction that has a 28% tax rate. Since I have to pay profit in the country where it's earned, I'm going to pay 28% tax on the foreign earnings profit before tax. When I consolidate that profit before tax on my statements, I'm facing a statutory tax rate of 35%, but I've already paid 28 cents on the dollar. So the incremental tax rate associated with the income from that jurisdiction would be 7%. It would just be the incremental difference. And it may be the case that the profit itself is not taxed until repatriation. So this is a big thing in the U.S., where an American-based corporation with subsidiaries around the world can make money in different jurisdictions with different tax rates, with much lower tax rates. But as long as they don't bring that money back into the U.S., as long as they don't repatriate that money, they don't have to pay tax on it. If we look at Apple's situation, Apple has billions of dollars outside of the U.S., but it can't bring it back, otherwise it has to pay tax on it. So what Apple did was it issued debt in the U.S. to do a stock buyback, as opposed to bring back that profit, pay tax on it, and then give it back to shareholders. They just issued debt because it was cheaper to issue the debt and pay the interest than it would be to repatriate the money, pay the tax, and then pay out dividends. Disclosures. Must provide an explanation between the tax expense and accounting profit. What this means is that you have to reconcile the statutory tax rate with the average effective tax rate that you paid. So if the statutory tax rate is 35% and your effective tax rate is 28%, there'll be a bunch of adjustments showing how you got from 35 down to 28%. And we're going to see some of these adjustments shortly. Okay, here's an example taken right from the curriculum. Here's the income tax using the company's domestic tax rate. They're facing a 25% statutory tax rate. In 2010, it was 25.5. Now it's 25. So tax rates are dropping a bit in this country. The effect of tax rates in foreign jurisdictions. These are just adjustments. So we see in 2010, it had the effect of adding 1.9% to their effective tax rate. In 2011, it had the effect of adding 3.5% to their statutory tax rate. So we can see that because the company has a statutory tax rate of 25, we're increasing it by 3.5%. That profit is made in higher tax jurisdictions. If it were made in lower tax jurisdictions, it would have the effect of lowering the statutory tax rate. Now, look at this. What happened from, this is an important point, what happened from 2010 to 2011, and you could pull a lot of information out of this, right? We went from 1.9% on the tax rates in foreign jurisdictions, added 1.9 percentage points to the statutory rate, to adding 3.5 percentage points. So there are two explanations for this. Which one it is, you really don't know until you ask more questions. It could be that from 2010 to 2011, the company did more business in countries with higher tax rates, or it could be that wherever it was doing business, tax rates increased, so that it didn't do more business in higher tax rate countries. It did the same business in all countries. It's just tax rates in general across a number of countries went up. So we can look at this and we can say, well, do we want to dig into this a little bit more and find out what was it? Are you increasing sales in a higher tax jurisdiction? That's okay. I mean, there's nothing wrong with that, because the government doesn't take every penny of every dollar. It takes a percentage, right? So if it's just a result of more sales in a higher tax jurisdiction, that's not bad. But if it's the result of saying, well, no, we didn't do more sales in any particular area, just tax rates are increasing, that's a dangerous trend, because that is government stepping in saying corporations have to shoulder a greater burden of the tax hit for a particular country. That's not good for investors. Now, when I say that's not good, I want to be very clear, because it really depends on where on the political spectrum you sit. If you're a conservative, it's not good at all, because you think, well, you're going to hurt investment with higher tax rates. If you're on the right, you say, well, it is good simply because you have to lower the tax burden on the consumers, and who else is going to pick it up, right? So when I say that it's not good for investors, and it's not good for valuation. Higher tax rates overall will lower valuation because you'll have less net income. But if you want to look at it in terms of a wider social impact, there is an argument that could be made that says if you reduce the burden on the consumer we like to think makes up anywhere from 50 to 70% of GDP. That's a lie. That is just a lie. The consumer makes up 100% of GDP. Every tax dollar has to come from a consumer. Now you think, but you're taxing corporations. Only if they're profitable. And if corporations are profitable, where did they get that money? They eventually had to get it from a consumer somewhere. So if you trace out all the money in GDP and where it comes from, it all comes from the consumer. So if you have a healthy consumer, if you leave them more money, there's greater demand. Corporations make more money. Even though there's a higher tax rate, they still do okay. So when I say that it's bad, please don't send me emails saying, you got to think about the social impact. I get all that. It's good, I think, from a social perspective, but we're analysts. We're coming up with a valuation. It's a net negative for valuation. That's when I say it's bad, focus on that. It's a net negative for valuation. Your own politics may say, but it's a positive. Yes, there's nothing wrong with having it a net negative for valuation. That's what it's worth now. We want to be as objective and cold about our valuation as possible. We don't want to, fall in love with the idea of how do we continually increase. That's for somebody else to figure out. We just want to look at it in the cold light of reason, right? Okay. I think I went a little hard on that, but I want to be clear on that, because I do get pushback on that idea by saying, well, higher tax rates are bad. I do get pushback on it. And when I say they're bad, I mean it from a purely valuation point of view. It lowers valuations. So let's look at another one here. This is over 3 years, 2009, 10, and 11. The tax at the United States statutory tax rate, this is a U.S. parent, 35%. If you look at the effective tax rates, 32.2, 0.6, and 0.6. So this is a disclosure that the company has to make, is it has to reconcile how it got from the statutory tax rate to its effective tax rate, and we can see all of the components. For the ones that we're interested here, it's the earnings taxed at other than the United States statutory rate. Remember, the parent, if it has subsidiaries in other tax jurisdictions, it will change the difference between the statutory and the effective tax rate. It will be a line item in this reconciliation. So we can see here from 2010 to 2011, Look at from 2010 to 2000, earned more profit in higher tax jurisdictions. Why? Because in 2010, we were able to reduce the statutory tax rate by 4.6 percentage points because of foreign operations, but only by 1.7 in 2011. So again, and we can see across all years that this profit here, these are lower tax jurisdictions. The profits that our subsidiaries are making are occurring in lower tax jurisdictions because it's bringing down the statutory tax rate towards the effective tax rate. So again, you can ask the question, did the company earn more profit in higher tax jurisdictions, or were tax rates increased where it did earn profit? All right, so let's look at the how changes in the components of sales affect sales growth. And we're used to recognizing two separate components, quantity and price. Increases in quantity will increase sales. Increases in price will increase sales. The best increases are ones that include both an increase in quantity and an increase in price. We want to be able to charge more year after year for what we sell because we want to make the argument that we continually add value so that we can raise prices. It gives us pricing power, and we want to sell more quantity. But there's a third component, especially if we have foreign subsidiaries, which is the exchange rate. It could give us sales growth without any really underlying quantity or price increases. So we can think of sales growth as being equal to quantity times price times rate, or the change in any of these three components. So let's put our quantity at 10 and our price at 5 when we have an exchange rate of 1 for 1. Then we'll increase it to 1.1, 1.2, 1.3. So we can see Q times P is 50. Next year would translate at 55, 60, 65 because we have an appreciating currency in our foreign subsidiary. So every dollar that we make there buys more and more of our domestic currency because the foreign currency is appreciating. So we have sales growth from 50 to 65 over this period of time. That gives us a sales growth rate of 9.13% per year. However, organic sales growth is 0%. Organic means that all we're going to do is look at just the quantity and the prices that it was sold at. And that gives us our organic sales growth. So that is an unsustainable sales growth simply because if it's coming from the currency, it's not going to go in one direction and continue on, and management really has no control over that. So companies will typically back that out when it's in the disclosures, or maybe in the MD&A or in investor presentations, it'll back that out to show its level of organic growth. So if we look at what we have here, this is fiscal 10 versus 9, fiscal 11 versus 10. Contributions from volume growth, 6 points versus flat. Net price realization and mix, 1 and 3 points. So we can see that Q added 6 points of growth in 2010 over 2011. Quantity was up 6%. Price was up 1%. The currency exchange was flat. So that means that 7%, the net sales growth that we got, 7%, is the good growth. It is, and it's heavy on volume, which is nice, but it's volume and price. It didn't add anything. The year before, 2010 over 2009, we saw that sales growth was 4 points, but one of those points came from the currency itself, so that the organic growth itself was only 3 points. So you will get this kind of a disclosure to get down to organic growth, because that's a metric. It's not an accounting metric or a GAAP metric. It's just a nice valuation metric to look at on its own, without anything outside of management's control. What is the level of growth that management has that we can point to and say that belongs to management? And that's what organic growth is. All right, let's look at currency fluctuations and financial results and how they impact financial results. And a lot of this we've already seen. I've taken some time to point it out in several different places, but we'll just bring it all together now. One thing that's important to bring up right off the top is we've talked throughout this reading about using the current rate method or the temporal method, depending on whether or not the functional currency of the subsidiary is equal to or not equal to the parent's presentation currency. It could be the case that a parent with 10 subsidiaries has 9 of them that are using a current rate method and one of them using a temporal rate, or 5 and 5. So a parent may have subsidiaries using temporal method and others using the current rate method. So here's the result of that. It results in both a translation gain or loss on the income statement from the temporal method and a translation adjustment gain or loss on the balance sheet. So we may look at a parent and say, well, hang on a second, there's a translation adjustment on the balance sheet saying that it's using current rate, but I also see a translation gain or loss on the income statement, meaning it's using the current, it's using both? Yes, it can. Remember now, the translation method is associated with the subsidiary, not with the parent. It's not that the parent uses current rate. It's per subsidiary, do we use current or temporal? Move on. Next subsidiary, current or temporal. So the decision is made at the subsidiary level. So you could have a parent with both methods on its balance sheet and income statement. So let's have a look at what we have here. Look at across the top. This is the temporal method with a net monetary liability exposure. Here we're using the temporal method with net monetary asset exposure, and here we're using current rate method. As we know, because assets equal liabilities plus equity, the current rate method will always, unless you have zero equity or negative equity, the current rate method will always have a net asset balance sheet exposure. Which means the temporal method with net monetary asset exposure should have the same results as the current rate method. And if we look at the direction of the arrows, here is the foreign currency strengthening. So revenues, assets, and liabilities are up. Revenues, assets, and liabilities will be higher. Net income shareholder gain will be up. Net income shareholder gain will be up. Translation gain, positive translation adjustment. Remember, that's the income statement, that's the balance sheet. So if you look at the effect on each of these accounts, you'll notice that if we have, we want to focus on temporal and current method, but in a situation like this, it's better to focus on what exposure you have. This is the temporal method with an asset exposure. Current rate method has an asset exposure. These two are identical. So when the currency strengthens, all of these balances increase. When the currency weakens, all of the balances decrease. If it strengthens, we get a gain. If it weakens, we have a loss. That's straightforward if we have an asset. So, as I said before, when we drew one of these charts out, here's the foreign currency strengthening and weakening. Here's net asset exposure. And I said, think about it this way. I'm Canadian. I got $100 US in my pocket, which means I got foreign currency in my pocket. I got 100, so that's an asset. What benefits me? When it strengthens. That's all I have to know. That's all I have to remember. Why? Because if that's a plus, this is a minus. If that's a plus, this is a minus. If that's a minus, that's a plus. I don't have to remember this whole table. I just have to remember that little scenario where I got $100 in my pocket, and if the foreign currency strengthens, good for me. I put a plus sign. This is the currency strengthening. It turns into a gain and a gain because what? We have positive asset exposure, or net asset exposure. I shouldn't say positive asset, but net asset exposure. The temporal method with net liability exposure is just the opposite of what the asset exposure is. But look here, revenues, assets, and liabilities will still increase. It still moves in the direction of the currency. So when we look at revenues, assets, and liabilities across all these scenarios, they will move in the direction of the currency. If the foreign currency strengthens, all three of those will go up. If the foreign currency weakens, all three of them will go down in every scenario. But look what happens with net income and shareholder equity. While everything is going up, it's going down because look at if we have asset exposure, it goes up, we have a gain. Asset exposure here, it goes up, we have a gain. Liability exposure, it goes down, we have a loss. And here we have the currency weakens, whereas here it would drop with a loss, here it increases with a gain. So does that make sense? Well, let's find out. This is the foreign currency weakening, and this is a net liability exposure. What do we have here? We have the foreign currency weakening, net liability exposure should be positive, and there it is right there. It says gain right there for us. Let me underline that. So we've seen this plenty of times. Now, here's the deal. You're going to get questions like this. You're going to get questions that ask you, given this, you may be given in the scenario, you may have a balance sheet and an income statement, and there might be a question saying, if you were using the temporal method, would you expect and given the currency, given what the currency rate has done, because it might be information in the question, we are most likely to see what on the balance sheet, or what on the income statement, or what's the translation effect So you would have to know, well, let's see, let's have a look at this balance sheet. We're using the temporal effect, so I'm just going to look at the monetary assets and the monetary liabilities. Where's my exposure? If I have net liability exposure, I'd like to see the foreign currency weaken. Net liability exposure, foreign currency weakens, we get a translation gain. I say we would like to see it because I'm biased to gains and biased against losses, but you really should be able to put all of that together. You really should be able to trace this kind of stuff together, and it's quite simple. It's just very, very simple. Don't focus on temporal and current rate, because then you have three things to think about. You have temporal with liability exposure, temporal with asset exposure, and current rate. Think about it as just asset exposure or liability exposure. If it's asset exposure, I'm going to go with the currency. If it's liability exposure, it's opposite. And you don't have to remember what liability exposure is, because if you can remember, like I said, I'm going to circle it again. If you can remember just this, you can fill in the rest of this chart and everything is easy. All right, let's just wrap up this last learning objective, and it wraps up the chapter, and look at some disclosures. IFRS and GAAP have to disclose two things. Number one, the amount of exchange differences recognized in net income, and the amount of cumulative translation adjustments on the balance sheet. So we know that the amounts recognized in net income come from the temporal method. The translation adjustment account in the equity section of the balance sheet comes from the current rate method. And if we're using the current rate method, a reconciliation of beginning and ending cumulative balances. For GAAP, the amount transferred from the balance sheet to the income statement when the foreign entity is sold or disposed of, that's got to be disclosed. There is no requirement, and this kind of makes it a little bit difficult sometimes. There's no requirement to separate amounts from transaction gains and losses. Remember, we saw this at the opening of the chapter. We dealt with transaction gains and losses versus translation gains and losses. Now, only the temporal method would matter, because if we're using the current rate method, the translation gain or losses in the equity section on the balance sheet, we can see that. Any transaction gain or losses on the income statement, it's separate. What hits the income statement? Only the translation gain or loss using a temporal method. But the nice thing is, as I've said earlier, it's not really used that often, the temporal method. But when it is, then there is no requirement to separate amounts from transactions to translations. Whether the company does or doesn't will depend on whether they feel it exposes too much of their business model. Or if it's not significant in exposing anything, they'll give you the information. But if they think it exposes too much, typically you'd get that at analyst meetings with management, as opposed to broadcast out in public. That wraps up this reading. I've left some of the examples out. There are a couple long examples, but I think that we've covered everything. We've done everything, and to put more examples in this would just be repeating some of the stuff that I've already done. But if you want to go through the chapter and just read the examples I missed, then off you go. One final thing I should note on disclosure when we talk about foreign currency, it's really not a big thing in this chapter, and it's not part of the learning objective at all. But when you read the annual report under risks, there'll be a whole section under foreign currency, risks under foreign currency, and not just the general statement that we have no control over currencies and we don't know where it goes. Sometimes they even provide sensitivity analysis that's saying, look, we have a lot of exposure to a particular currency. For instance, Canadian companies, American companies tend to have very large exposures to each other's currency. So they might provide sensitivity analysis, especially when currencies become volatile. They might provide sensitivity analysis saying, look, given the currency rates the way they are, you never know what's going to happen. Here is a likely scenario for so many pips increase, so many pips decrease, whatever the case is, whatever range they want to provide sensitivity over. They might even provide that. More disclosure is always a good thing, because it's just more information that you have that you can work with. All right. That's this reading done. That's this study session done. Let's move on to the last two readings that we have. We're looking at the quality